From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The open about 2 hours away. The jobs report 60 minutes away. And going into all of that, equity futures negative by 1/3 on the S&P. On the Nasdaq, we're down by 0.4. So just pulling back just a touch. We're 2 hours until that cash open. Let's get you some morning movers. Let's cross over to Manus Cranny. Good morning, Manus.
Jonathan, good morning. The world is trying to grapple with what's happening in LA politically, and from a human point of view, the horrors are all there to see. But this is about the financial repercussions, and that's what we're beginning to put some numbers around. Travelers Inc. JP Morgan have doubled their estimate in terms of the actual cost of these wildfires to $20 billion. That is overnight. Now, there's a consequence to that because a number of stocks are impacted, Allstate, Chubb, and Travelers. Travelers is perhaps the most exposed. Primary insurers will bear the majority of the burden. This is a more significant and more severe impact than the Butte County Camp Fire in 2018. So this is, in some way, a financial translation of the horrors of the LA situation. To Nike, a vote of confidence in the new CEO. You've got Piper Sandler upgrading the stock to overweight. Elliott Hill's intensified urgency. Possibly early with their call is what they're saying, but healthy, profitable growth might not just be now, it'll be 4 quarters away, but it's a nice upgrade for them. Upgrade yourself. Apparently millennials do. This is for Delta. Overseas business, travel, both of those combined, nice rebound in the Delta numbers. They've also guided higher. This quarter they're going to make up to $1. The market had estimated around 76 cents, so 75 up to $1. Free cash flow, $4 billion in this first quarter, Jonathan. That's up 18%. And as I say, 85% of the seats that this company is going to put into their plane, they are premium seats. Millennials. I never afforded business class travel when I was a millennial.
Of course not, Manus Cranny. Of course not. I used to fly with Manus. I'd take a right, Manus took a left every single time. That's how it went. Manus, appreciate your time.
Wait,
cut the mic now. No, he can't respond.
Pause.
He can't respond.
No, pause. You, as a young lad.
As a young lad?
As a young lad.
Ryanair.
Yeah, you, wait.
Didn't allocate seating.
So hold on a
across
second.
the tarmac and try and get a seat and block the other seats for your family.
You were the person who actually sprung for the high end when you were like 23.
Absolutely not.
100%.
No way.
Yeah, you were like in the lounge.
Ryanair.
Sipping champagne.
London Stansted into Bari.
When did that change?
No seats when I got a job. No seats. Used to run across the tarmac. Used to try and block the seats for your family.
Yeah.
And how do you block the other seats? Is it a short?
This. They're taken. And then someone would say, they're not taken. Where are they? And I'd say, they're coming. And then, you know, then the row would start. It was some violent stuff with Ryanair. They'd try and take your bag off you and say it was too big. They'd force you to put it through this metal thing to see if it was too big or not. I'm sure they still do that. Michael O'Leary's made the experience a little bit more pleasant, I have to say, over the last decade.
Those days are long gone. Now you're full-on lounge.
Yes, and I charge it to work, as I should. Under surveillance this morning. Delta Airlines beating profit estimates in the fourth quarter, seeing gains in international and corporate travel. The airline expecting elevated demand through the year, as it also continues its push into premium products and services. The stock is up by close to 7% this morning. Phenomenal performance from that company over the last few years. Really a market leader in America in many ways. days.
And how much does this really point to an industry-wide standard that they all can charge more because there just have been fewer plane deliveries, which has lowered capacity. They're all trying to shift into premium because evidently millennials today don't want to do the Ryanair experience where they go to fisticuffs with other people about saving seats for people, which maybe isn't a terrible thing. But it just speaks to this idea also of international travel and how that has continued to be strong. And I wonder how much that has to do with the dollar.
There is an obvious bias around the table we should reveal. Delta, American, United. You know, we all have our own airlines here. Mohammed, can we make the shift to Delta? Does that work for you, or are you just staying with United?
I'm happy for Lisa to stay with United.
Ooh. Ooh. Shots fired.
Yeah, no.
What's so special about United? What's Kirby done over there that makes you just so loyal to that airline? What's it about?
I think it's more about me than about United. I like predictability, and I know exactly what the seat's going to look like. I know exactly what service I'm going to get. I know exactly what food I'm going to get.
The street waffle.
No more street waffle.
No more street waffle. They killed that. When did they kill that?
About a couple of years ago.
I didn't know that. Why did they kill that?
I don't know. You should ask.
It's your favourite snack. All right. It's a conversation for another day. About a week for UK bond over the last 5 sessions. The most in a year. The 10-year yield hitting its highest level since 2008. The 30-year since 1998. Investors concerned about Labour policy and an escalating government debt burden. Mohammed, we talked about this a few times already this morning. What do you think is the biggest difference now, between now and, say, 2022, and the so-called Liz Truss moment?
I think it's a functioning of markets. So 2022 was a breakdown in the functioning of markets, and that immediately spread the disorder all over the place. Here, the markets are functioning well, but the economy is going to have to deal with higher yields. The economy is going to have to deal with higher yields at the time when there's very little policy flexibility. So this basically eliminates all the headroom that the Chancellor had on fiscal policy, and it will also constrain what the Bank of England can do.
If there is an upside surprise in U.S. payrolls, I just wonder how bad that afternoon is going to be in the United Kingdom at a time where right now markets are orderly. If there is a huge moment of volatility, does that change?
Important stuff. One more note. You know the street waffle? And this is an important note. Do you know it was designed to sit over the cup so that it softened, the caramel would melt a little bit?
Yeah, of course.
That's why it's that size. Do you know, I didn't know that. I didn't know that until recently. You're meant to put it on top of a hot coffee or something, and then it melts a little bit.
Correct.
That sounds absolutely dreadful on an airplane to have melted caramel all over the seat.
No, it stays in the street waffle.
All right, well,
it stays in there.
Maybe they're moving to more healthy kind of
snacks. You learn something new every day. I learned that the other day. President-elect Donald Trump, I want to squeeze this story in, saying a meeting with Russian President Vladimir Putin is being arranged, telling a group of GOP governors gathered at Mar-a-Lago that Putin, quote, wants to meet, and that any such meeting will take place post-inauguration.
Russian authorities said that they haven't been contacted, so that they are not necessarily, this is according to a number of sources. Nonetheless, there is real speculation about how quickly President-elect Donald Trump will move to end the conflict between Ukraine and Russia, and just whether this gives Russia more leverage, whether this will leave Ukraine with a worse deal, exactly the contours of this, and just how on board Vladimir Putin actually is.
Yeah, watch this space. Let's turn back to the tragedy in Los Angeles. Multiple wildfires continuing to burn throughout the city. Nearly 200,000 residents have been forced to flee their homes, and 30,000 acres have been scorched so far. Firefighters working round the clock to try and contain the fires. Joining us now is Alex Da Silva of AccuWeather. Alex, welcome back. Are things getting any better?
Yeah, unfortunately, things continue to get worse, and we have the numbers here. 92 wildfires in total have broken out across Southern California. Of course, we have the main 2 or 3 or 4 fires, but there's been other ones that have been sparked by some of those embers blowing ahead of the main parent fires and sparking new fires. Unfortunately, we've had 5 confirmed fatalities, but I've seen new data that would suggest that number is closer to 10, unfortunately. And like you mentioned, about 30,000 acres have been burned, along with 10,000 plus structures. Again, we're tracking the 3 main fires, Hearst, Palisades, and Eaton fires. And unfortunately, each and every one of those fires is 10% or less containment right now. The winds continue to blow pretty strong in Southern California, and I think they'll continue to do so throughout the day today. They might relax a little bit tonight, but it looks like this weekend they might pick up yet again, unfortunately. This is all fueled by a big area of high pressure that's moving down across portions of Nevada. That is what has caused this event in terms of the winds. Low pressure to the south, and then kind of that gradient between them causes this wind coming out of the east. So that's why we've seen these very strong winds across the area. New damage estimates from AccuWeather Now we're calling $135 to $150 billion in economic loss across Southern California, and that's about 4% of California's annual GDP. Now, this is not just physical damage. This is insurance losses as well, tourism loss. We look at the NFL game that has been moved to Arizona. That is also factored into economic loss as well. We look at healthcare premiums. Those might come up a little bit with all the smoke, people having allergy problems due to the fire. So it's not just about the physical damage. When you have an event like this, it really goes much more beyond, unfortunately, the physical damage. And then how does this event rank amongst other natural disasters that we've seen in recent times? You can see the Cal fire is up here, and it's very considerable.
Pretty shocking stuff, Alex. Appreciate your time, sir. Alex De Silva there of AccuWeather on the latest. Let's talk about the cost of things. Bloomberg Intelligence expecting that insured losses from the California wildfires could be between 10 and 20 billion US dollars under some scenarios, saying it will be a large but likely manageable event for public insurers. Joining us now is Matthew Palazzola of Bloomberg Intelligence. Matt, it's good to see you, sir. Under difficult conditions over in Los Angeles, do we know what started this fire? Have we got any detail whatsoever?
As of yet, no. So CAL FIRE is really the source you go to for this, and they're saying still under investigation. I mean, I think they're still focused on, fighting it at this point, and usually that comes out it could be even months after.
Do we have a sense of what proportion of homes that were destroyed were actually insured by some of these public insurers versus either completely uninsured or insured by the insurer of last resort, the state?
Yeah. So in the main affected zip code, about 15% of those homes are in the FAIR plan. I don't have data on uninsured homes. Anecdotally, you sometimes hear these very, very high-end homes, maybe they go without insurance because it's so expensive, but I mean, generally they're mostly insured. So mostly insured with about 15% in the FAIR plan.
Can you give us a sense of just how many insurers pulled out of California in the years leading up to this because of some of the mandates coming from local legislation?
Yeah, so the biggest ones did. So State Farm has been pulling back, Allstate has been pulling back, a number of smaller ones have been pulling back. And what they've said publicly is wildfires, climate change, but Lisa, like you said, the regulatory climate there is very difficult for them to operate. So it is actually, I would think, the primary reason a lot of them pulled back. Just for an example, that FAIR plan, the state kind of doesn't run it, but gives it powers and kind of has power over it. They made the FAIR plan increase the limits that they take, right? So they have to insure a higher amount. And the FAIR plan said, well, we need more rate, and then the state didn't give them as much rate as they needed.
So Matt, take us from what has happened to what is likely to happen. Typically, after a tragedy, we see two things in the insurance market: higher demand for insurance, lower willingness to supply insurance.
Yep.
So what do you think happens here?
Yeah, no, I think that will happen here. I've got this kind of blue sky scenario that maybe this forces the state regulators to the table to work with the insurers a little bit more. It's probably an unlikely scenario. I think what happens is you will see a opportunity for the residual market insurance companies or excess and surplus insurance companies that don't operate kind of in the more regulated space to write these kind of more freer form policies. But I don't think this helps the cause in the state at all. In fact, I think the FAIR plan, the solvency of the FAIR plan could be at risk.
So when we are sort of trying to think about how quickly the rebuilding goes on, how quickly do we get back to a new sense of normal, do you think the insurance element is a big issue to think about, or just a marginal issue at this point?
So I would say, I think the rebuilding happens fairly quickly. You could look at like the Maui fires and like, we get to work on that stuff pretty quickly. I don't think, we talk about, there was hurricanes last year and flooding there, and there's more of a chance that perhaps insurance doesn't pay for some of those things than with the fires. With these wildfires, they understand that it's risky and there could be carve-outs, so I'm not saying everyone gets coverage, but there's probably less of a question of insurance coverage in a case like this.
If the FAIR plan is insolvent, which is what you raised the specter of, and I just want to end there, this is the California program of last resort. They insure up to $3 million, I believe. A lot of these homes are far beyond that. Do we have a sense of what the necessity will be of California for federal financing to cover any kind of additional funding at a time when I think it's $700 million the FAIR plan has currently in financing?
Yeah, so the FAIR plan's financials are not exactly public, right? So we don't know the ultimate claim paying ability. They will, first step is they can access a line of credit. I don't know who's going to give them a line of credit. Maybe the state gives them a line of credit. Then they assess insurance companies, and they can keep assessing insurance companies, but once they get over a certain amount, the insurance companies can pass that cost on to policyholders. So there's a couple of things in the waterfall before federal funding. I'm sure some FEMA money comes in, but they have some kind of stopgaps before that happens.
Matt, thanks for your time. Appreciate it. Just devastating stuff coming out of Los Angeles and beyond. Matthew Palazzolo there of Bloomberg Intelligence with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Walgreens shares up nearly 11% in the pre-market trade. It reported stronger than expected quarterly results that helped ease pressure, with Walgreens currently considering strategic options, including a sale. Revenue for them came in at $39 billion for the quarter. That's thanks to higher prices for branded drugs and prescription volumes at Walgreens' U.S. retail pharmacy division. U.S. tech billionaire Elon Musk has waded into Germany's election, hosting a conversation with far-right candidate Alice Weidel on his X social media platform. The discussion ranged from Hitler and Stalin to aliens and a human settlement on Mars. It lasted just over an hour. The X Spaces event with the leader of the Alternative for Germany party comes ahead of federal elections for the country next month. The Supreme Court hears arguments today on TikTok. It's the company's last-ditch effort to keep the social media app running in the U.S. A federal appeals court had upheld a law that will ban the app if it isn't sold by its Chinese parent company, ByteDance. President-elect Donald Trump is asking the court to hold off on the ban, which would shut down TikTok on January 19th. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. I just wonder, and I've been thinking about this over the last week or so with the changes at Meta. Is Meta and Mark Zuckerberg doing enough to change the incoming president's mind all over again on TikTok?
We shall see. I think it's sort of, is it Mark Zuckerberg's role, or is it the number of followers that the campaign has assembled on TikTok, as we've kind of heard?
We've heard a few arguments. He doesn't want to help Meta. I wonder if Meta's done enough to change his mind on that front, but I'm with you too. He's popular on the platform and probably wants to stay that way.
Does he really want to anger the kids?
She's not running again, is he?
I don't know.
Some Democrats might be out there. That's a different channel, Brammer. You want to pretend that Trump's running again? All right, different
Stop!
channel.
No.
Different channel.
What are,
different
really?
channel.
All right, let's.
Freaking out about term 3 and dictatorships. Wrong channel. Up next on the program, the payrolls report.
This is a moderating labor market. It's softening or going into softening, and that's not one where you can look at an individual kind of outlier number and really change your whole forecast for that.
That conversation up next, live from New York. Let's hope I'm still here after the break.
How about me?
This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Equity futures on the S&P 500 on this payrolls Friday, with that number dropping in about 40 minutes' time. Equities down by 0.2%. Bond yields just about unchanged, 468.75. Under surveillance this morning, the payrolls report.
This is a moderating labor market. It's cooling, it's softening or going into softening, and that's not one where you can look at an individual kind of outlier number and really change your whole forecast for that. I do think that there's still more room for it to cool. We do see the unemployment rate gradually rising over 2025 up to 4.4%. We do think that there is real reason that maybe post Q1 there's going to be a lot more discussions on whether the labor market's weakening.
So here's the latest this morning, less than 1 hour away from the December payrolls report. The median estimate in our survey calling for 165,000 jobs added and unemployment holding steady at 4.2%. Alan Zender of Morgan Stanley saying the labour market is gradually cooling, which makes sticky inflation the determinant of how long the Fed pauses. Prudent policymaking would dictate a wait-and-see approach to gauge post-inauguration policy. Alan joins us now for more. Alan, good morning. Good to see you.
Good morning.
Happy New Year. Thanks for being with us.
Yes, Happy New Year.
This is a little bit of a change because coming out of the summer, we were worried about employment. We weren't worried so much about inflation.
Yeah.
What's changed in the last few months?
Well, I think inflation has been sticky. Employment, yes, continues to gradually slow. That's fine. That's normal. That's what you want. But inflation has been more sticky, and the Fed has cut rates by 100 basis points. Growth is strong. Financial conditions are loose, although we can talk about the backup in yields. And so there's this sort of wait and see, which I believe in December, really the words they used in the statement indicated a hard pause, And the thing is that you've got this big looming event. What is that? It's the inauguration and the flurry of executive orders that can come out of that. And until you really start to see the shape of that, a lot of uncertainty tends to create policy paralysis, where it just makes sense to hold.
So is there anything that we could get today in about 40 minutes' time that could shake the paralysis that you expect at the Federal Reserve?
The rule of thumb is that if you get a horrible number, and it's a horrible number it's an outlier until you know otherwise, right? One data point does not make a trend. I think what you have seen is that if data is disappointing, we've seen at least bets that they could hike at some point come off the table. So I think you take that, continue to take that away in terms of the market expectations of what the Fed might do. Certainly the expectations of when they could start start cutting again would be pulled forward if we got a really terrible number, but I don't think it's going to change January's decision.
Do you have confidence, and I'm thinking about what Andrew Hollenhorst has been saying over at Citigroup, do you have confidence that the pillars of the labor market growth are strong enough to keep going without participation by other companies and real growth stemming from some additional places?
Well, as long as layoffs don't pick up. I mean, hiring has been slowing, right? But the other part of that equation is layoffs. When hiring is very slow, it doesn't take a tremendous rise in layoffs to push those numbers down to very low or negative jobs prints. And so we've got to focus more on layoffs because hiring is not going anywhere. There's not a lot of churn in the labor market. And so it's a fine balance when it just matters, you know, our companies laying off. We're not seeing that yet broad-based.
It's not so long ago that the view was inflation is orderly declining to 2%. We don't have to worry about the CPI report. It's all about the employment report. And the risk is to the downside.
Yeah.
Now that has changed. So speak a little bit about how do you see inflation dynamics going forward?
So I think inflation dynamics, you know, you saw, Governor Waller express confidence that, look, I still believe that it's going to gradually move toward our 2% goal. And I think if the economy slows enough, and maybe this backup in yields helps the economy slow further, maybe some of Trump's policies helps the economy slow further, then you can get more downward pressure on inflation. And I'm talking about beyond tariffs, right? Tariffs are going to be a one-off level shift in prices. As a policymaker, you should look through that because the hit to aggregate demand is going to have a gravitational pull on inflation later. And so I think confidence that it will continue to move gradually toward 2%, that's fine, but not in the near term. And so that does support probably a Fed pause here. You've also had a lot of change, Mohammed, at the January meeting, right? That's the housekeeping meeting where we see the shuffle, we shuffle the deck in terms of voters. The divide on the committee becomes even greater. And so unless the data is very clear, there's going to be no reason for them to move.
The probability of a hike this year?
I would say very low.
How low?
I don't put zero on anything.
Okay.
I learned that early in my career when I did say zero one time and I was wrong. No, I would say 15%.
It's pretty low.
How's that?
How helpful are the forecasts at the moment, or unhelpful?
You know, the forecasts are all, I mean, look, economists love to say, oh, it's tremendously uncertain. It's hugely uncertain. You can't do a dang thing about your forecast until you know what's going to come out of the administration.
Some people are, though. We've been told.
Yeah, but we have to, right? If you're forecasting the economy, you have to have a baseline. But you see that the baseline that everyone has for assumptions on how far will tariffs go, how many folks will we deport, are they economic contributors to the economy, or are they incarcerated or in the federal prison system, right? It matters who we're deporting as to whether it has an impact on the economy. Who knows? You know, take your pick. If you tend to lean bearish anyway, choose a baseline that assumes that tariffs are more onerous and immigration is greater than we think. If you tend to be a more bullish person on the economy, decide that Trump is not going to do much of his policies promised on the campaign trail at all. So it's something for everyone.
It's going to be a big year ahead, that's for sure. Yeah. Ellen, appreciate your time, as
you.
always. Ellen Zentner of Morgan Stanley. The next big stop for this debate, Lisa, 34 minutes away.
Yeah.
Payrolls.
As we get a sense of just how much momentum there is left in the market and the market's response to potentially a downside surprise to those numbers.
Stay tuned, 8:30 Eastern Time. In the third hour of Bloomberg Surveillance, the lineup looks like this. Nadia Lovell of UBS, Mike Collins of PGIM, Stephanie Roth of Wolfe Research, and Jeff Rosenberg of BlackRock. From New York City, this is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zabe Poland. He did come to me and Susan O'Malley, and they said, Abe Poland says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
You at least want to keep an eye on the labor market. That's really the only point of concern.
I think right now it's actually the unemployment rate. That's probably the single biggest data point we're going to get.
I don't think things are as calm in the labor market as the Fed kind of in their latest projection seems to view it.
This is a moderating labor market. It's cooling, it's softening.
If NFP is strong, then the Fed's cuts really come out of the table. Or if it's a really weak number, equities are probably going to look up and say, hey, maybe the economy is not as strong as we thought it was.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The payrolls report 30 minutes away. The third hour of Bloomberg Surveillance starts right now. Let's start with equities, move to bonds, and then I'll get you the guesstimates. Equity futures right now on the S&P 500, negative by 0.1%. On the NASDAQ, we're down by 0.2. In the bond market, I want to think about September 18th. September 18th on a 10-year, we were trading at 364. That afternoon, the Federal Reserve cut 50 basis points and then went on to cut another 50 over the next two meetings. Since then, they cut 100. This market moved 100 in the other direction on 10s. We're trading at 468.95. The next stop for the debate around the Federal Reserve, part one of a two-part story. It's payrolls today, and then it's CPI next week. The estimate for payrolls this morning, we're looking for 165. On Wall Street, of the 4 or 5 big banks we track, Citi's at 120 at the low end, Bank of America at the high end at 175.
Key question is, how much is this market really dependent on an upside surprise? And I'm talking about equity markets that have actually remained remarkably resilient in the face of this 100 basis point rise that we've seen in longer term benchmark yields. If there is a downside surprise, will the rally into the bond market, A, be really significant at a time where people are also worried about deficits, and B, be enough to really support equity markets that are hinged on growth, not just the rate story?
How much can change on one data point? We came into 2025 wondering whether this Federal Reserve could cut at all. Just before the commercial break, Mohammed was asking whether we'd need to hike interest rates later on this year. Mohammed, I'm sitting here wondering how quickly this can change all over again, and whether with a weak print in 28 minutes' time, we'll be discussing rate cuts all over again.
We could well, John. If you think of it, there's normally 3 anchors to views. One is policy. Does forward policy guidance. That's all over the place. So policy right now is not an anchor. Policy is a contributor on both sides, government side and central bank side, to volatility. The other anchor is technical. That's not much of an anchor because everybody has become data dependent. So you're left with, hopefully the economy can be strong enough to act as an anchor. And the reason why we obsess about these numbers is because we are testing that hypothesis over and over again.
We'll see how strong it is at 8:30 Eastern time. Bond yields into that higher by just a basis point, looking at the UK, because the UK will be looking at us in about 27 minutes, hoping that we get a downside surprise on the jobs report. Here stateside in America, the 10-year just about unchanged. Coming up on this programme, we'll catch up with Nadia Lovell of UBS with stocks on track for a losing week, Mike Collins of PGIM as the US bond market sell-off stalls, and Jeff Rosenberg of BlackRock reacting to December payrolls. We begin this hour with stocks lower as investors await the last payrolls print of 2024 and the first big data point of 2025. Nadia Lovell of UBS is staying bullish and writing, we remain constructive and expect the S&P 500 bull market to continue, supported by robust earnings growth. However, 25 could be a bumpier year due to government and monetary policies. Nadia joins us now for more. Nadia, good morning. Good to see you. What are you expecting on the government side? What kind of changes are you expecting from January 20th onwards?
You know, it's evident, it's very clear. We already hear news that President Trump is preparing several executive orders the first week as he takes the helm. And so what we expect to see some tightening on the border. We expect to see tariffs. We don't expect universal tariffs, but we expect selective tariffs continue against China. We don't expect to see any sort of changes to the corporate tax rate. We don't think that it will be in the budget. But we do think that overall, the policies will cause some volatility, at least the rhetoric around the policy will cause some volatility to markets.
Let's go with immigration first, and we'll break it down. We'll start there. Labour supply has been a huge feature of every conversation we've had about the labour market for the last several years. If you begin to constrain that and that story changes, where does that leave price pressures and wage growth?
Absolutely, because when you look at the last year, we know that the increase in labor supply has helped the job market. So the job market has loosened a little bit. And so if you do tighten the borders, it will affect in terms of some areas of the economy, particularly the lower wage workers, like when you think about consumer discretionary, restaurants, and those things can come under pressure. And you could see some upward increase again in terms of wage pressures. And that has implications for inflation. This is partly why you heard some of the Fed governors and the Fed participants in December saying that some are factoring the potential for increase in inflation due to the uncertainty around government policies.
There's been some fear that today good news will be bad news for equity markets, that essentially if there's higher than expected hiring and in particular wage growth, that you could see a 10-year, 30-year yield that climbs higher, that torpedoes some of the optimism for Fed rate cuts. Do you think that's the biggest potential risk, or is a bigger potential risk a downside surprise that questions that pillar that Mohammed was talking about of the momentum and growth underpinning this economy?
I think for equities, equities do want to see a fairly strong number to speak to the continued growth in the economy. We've had an economy that's been grown above trend. We've seen equity be able to perform despite the fact that you've seen a pickup in long end yields because the growth picture has been strong. strong. Now, in terms of, sort of the more interest rate sensitive areas of the markets, like, yes, they've been under pressure due to rates backing up because it does price out some additional Fed cuts. And the Fed right now is quite focused on inflation. So I do think that wage part is important, and then the inflation number next week will be important for the Fed decision.
What is the most interest rate sensitive part of this equity market?
Look at real estate. Massive pullback since the Fed pivot again in December. You're seeing pullback there. Parts of consumer staples, and then housing. Housing has been under pressure quite a bit. You've seen the backup in mortgage rates again, and you've even seen inventory start to build within the housing market, despite the fact that we know that demand still remains strong, but affordability remains an issue.
Nadia, when John read the opening quote from you, it said government policy and monetary policy.
Yes.
We've talked about government policy. Can you speak to monetary policy? What do you think will happen this year, and what do you think should happen this year?
So we think that you will get 2 rate cuts this year. Of course, a lot of this will be data dependent. And that pendulum, Mohammed, between this balancing act that the Fed has and the recalibration process, so that pendulum between, downside risks to the labor market and a potential upside risk to inflation is going to continue to swing back and forth to various degree. And right now, inflation is a concern. We're seeing tremendous progress in terms of on the labor market remain in solid progress on inflation. But the Fed, I think you want to see inflation come back under 2.5%. Core PCE is at 2.8%. And so if we can see progress that we're heading back under 2.5% on the way to the 2% goal, then that would be give the Fed some comfort in terms of continuing to cut rates. So we expect a pause in January. And also we know there's a changeover of the guard in the Fed, and the Fed is skewing a little bit more hawkish when you think about Muslim as well as, Schmidt coming on in terms of voters who tend to skew a bit more hawkish. And I think also the Fed is watching, policy coming out of Washington to determine policy.
And you're
from Collins.
And you're confident that 2 cuts is consistent with a confident path to 2% inflation?
We are. You can never be 100% confident right now because the data keeps changing, but we feel comfortable that 2 cuts this year will get us a pass. We expect core PCE to come back towards 2.5% by the time we get to mid-year. We've seen a pickup in inflation again. Some of this has to do with used cars, shelter, but we expect that to start to come down by the time we get to the spring and get to about 2.5%, and that will give the Fed some leeway to be able to cut.
Your long stocks. Let's finish on sector preferences. Where do you want to be right now? What do you like?
We continue to like tech. I mean, we continue to think that AI stories in tech, news coming out of CES this past week has been quite encouraging. And we actually took up our CapEx numbers for tech for this year. We've taken it up to 25% growth, expected $280 billion. And again, we think that those CapEx has room to grow even. The hyperscalers are spending quite a bit, but then the baton will get passed to enterprise as well as sovereigns, which we're watching closely just given all the talk around exports restrictions.
The numbers from Taiwan Semi, I think overnight, pretty decent,
yes,
right?
Very decent, 58%. Year-over-year growth for December. That bodes well for the AI story.
Do you think investors will retain that patience in some of the likes of NVIDIA's biggest clients? It's been a big focus for us on this program. The CapEx spend has been huge. Do they need to demonstrate a bigger return on investment this year? Or do you think that patience will be maintained through 25?
Do you think that investors do want to see a little bit more in terms of monetization? And you are seeing signs of that already in terms of whether it be on the advertising side and so forth. So we do think that, investors will be patient, but not too patient. We do want to see that gap between CapEx and monetization narrow, and we think that will narrow this year. But reality is a lot of this takes time to translate, and it could take another couple of years to sort of see that full, pickup in adoption.
Does that challenge the idea of a broadening out if basically the adoption isn't taking place and the big tech continues to be the winners in a sphere that's challenged by perennially high rates?
Not necessarily, because I think, you can see areas, you look at financials, right? Has been doing well, has given back some since election. But I think if the economy remains strong, if you're seeing a pickup in things like capital markets activity, if you're seeing a pickup in M&A, those areas of the markets that do well. And then also when you look at, yes, the manufacturing side has continued to be in a contraction territory, but new orders are starting to pick up. And so if that continues to happen, you can get some relief on the more cyclical areas of the economy, whether, it be industrials and other areas like that. So we don't think that limits the broadening out. We don't expect the same sort of exceptionalism from tech that you've seen last year. We expect it to outperform, but we think that other sectors can also perform well.
Nadia, appreciate your time. Good to see you, as always. Thank you. Nadia Lovell there of UBS. Looking ahead to next week, once we get through payrolls in just a moment, January 15th is a big one. Get CPI that morning at 8:30 Eastern time, and numbers from JP Morgan too.
Which is going to be more important? I was actually just thinking about that. At this point, with earnings coming out, I think that Delta is actually fascinating. Is this a demand-supply story, or is this just the fact that people keep traveling because they have the money to do so, and really a consumer-driven economy story? And we're going to be continuing to debate that as we get some of these numbers.
Numbers good from them. The stock is up big time in the pre-market. Up next on the program, we'll be running through more estimates around payrolls and what's going on in fixed income. Before we get there, let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Nearly 200,000 Los Angeles residents have been forced to evacuate, with 5 wildfires continuing to burn throughout the city. Firefighters have made progress in containing some of the blazes. AccuWeather estimates that the damage and economic losses could be as much as $150 billion. That would make it one of the most expensive natural disasters in modern American history. NVIDIA is criticizing President Biden on the new chip export restrictions that his administration is expected to soon announce. NVIDIA says that the White House is trying to undercut the incoming Trump administration by imposing last-minute rules. The AI darling says that the new rules will harm the U.S. economy and do nothing to promote national security. Elon Musk expressing doubts that his government efficiency task force can achieve $2 trillion in cuts to the federal budget. Musk says that he now thinks $1 trillion is more realistic of a goal, but even that would be challenging. The $2 trillion target would require significant cuts to popular programs like Social Security and Medicare, which is unlikely to happen. And that's your brief, John.
Danny, thank you. Appreciate it. Up next on the program, we'll get you some morning calls. Plus, Mike Collins of Peacham, fixed income. As we count you down to December payrolls, Mike's thoughts on whether we're in the buy zone in this bond market. That's next. This is Bloomberg.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
payrolls, 15 minutes away. Equity futures into that negative by 0.2%. The estimate in our survey, the median, 165. Before we get to that number, let's get you some morning calls. First up, Piper Sandler, upgrading Nike to overweight, expecting a return to profitable growth within the next year. That stock is up by 0.7%. Your second call from Needham, upgrading Lululemon to buy, citing potential re-acceleration in US trends following a strong holiday season. That stock is up by 1.6%. And finally, MoffettNathanson downgrading Roku to sell. Analyst Michael Nathanson noting a competitive pricing environment and lack of M&A. That stock is down by a little more than 3%. Turning to the labour market, stocks and bonds retreating ahead of the December payrolls report coming in just a few minutes' time. Joining us now to discuss is Mike Collins of PGIM Fixed Income. Mike, Happy New Year to you, sir, and welcome to the programme. I want to start in your bond market. We've had the equity strategists come on and say the bond market's in the danger zone for risk assets. We want to know if it's in the buy zone for you.
Yeah, from a fixed income perspective, Jonathan, I think we are unequivocally in the buy zone, right? I mean, rates have backed up a lot, like you mentioned earlier, 100 basis points just since the Fed started cutting rates. That's historically a gigantic move. Right now, there's basically just about one Fed rate cut priced in over the next 10 years, all right? And could the Fed stop at 4% on the funds rate and keep it there for 10 years? I guess. But man, with the incipient nature of the weakening in the labor market, the preponderance of the data really seems to point to, a bias toward a chance that you're going to have much weaker than expected job market data or inflation data at some point over the next few months.
Mike, can you elaborate on that? Because what a lot of people think has changed over the past couple of months is exactly the opposite. That weakness in the labor market was viewed as something that was temporary. We actually saw a resurgence. Corporate profitability held up better than expected. And that is an ongoing story, as we saw this morning with Delta. I'm just wondering, what gives you confidence that the trend is weakening and not the opposite, some sort of resurgence in inflation?
Yeah, I mean, there's not a high level of confidence in any of these calls right now, Lisa. In fact, in our portfolios, we're just inching out into a longer duration position as we reach these new yield highs. But we've gone through this huge increase in jobs, almost historic level of increase in jobs lately. But you are seeing at the fringes, right, weakening leading indicators in the jobs market. And it just seems like the markets have fully priced in the continuation of this resilience you're talking about, the continuation of strong economic growth, of higher than expected inflation, of strong jobs data. And when that gets fully priced in, we just think the chance of a downside surprise is heightened here.
Mike, when people look at the attractiveness of fixed income, they tend to look at all-in yields. They tend to look at all-in U.S. yields dominated by treasuries, as you know, at the 10-year at 4.69. Suppose I took you away from that and say, comment on, would you buy here? Would you bet on corporate spreads? Would you bet on the UK? So take us away from how we sort of go in the summary statement and other elements of fixed income. What would you bet on when it comes to the other elements of fixed income?
I mean, that's a great point, Mohammed. The value right now, the long-term value in the fixed income markets, especially in the U.S. fixed income markets, I think is in the government bond component, right? The incremental yield you get or that excess spread you get in investment grade corporates, in high yield corporates, in other risk assets, even though the multiples in the equity market I would put in the same category, are at risk, right? I mean, and you're in a situation where if you get upside surprise in the data and rates jump again, that could continue to put pressure on fundamentals in corporate America, fundamentals in earnings. On the other hand, if you get a big downside surprise in growth or inflation, that starts to question the resilience of these profits and growth. So I really think risk assets, kind of like the treasury market, are a little bit on a knife's edge here, could move in one direction or the other pretty quickly. But it seems like, again, the probabilities are starting to skew more toward rates falling and credit spreads presumably widening here.
And how bad can the widening be? Some people will say yes, but you're being compensated, so take that risk anyway. Where are you on this?
Yeah, I mean, the fundamental backdrop, Mohammed, is really solid. And we're seeing default rates, or at least our expectations of default rates in the high yield market, actually coming down. You've actually seen in the latest, quarterly earnings, the fundamentals in the high yield market, for example, continue to actually improve or remain really resilient. Companies, yeah, they're issuing a ton of debt, but it's almost all being used to refinance existing debt, to term out debt. So credit fundamentals, earnings fundamentals, are actually really solid in the credit markets. I look at the structured product markets. I mean, they're really solid backdrop for those markets. So yeah, I think any spread widening is a buying opportunity, and we're really light on credit risk right now in our portfolios, looking for opportunities to buy. Unfortunately, I think the whole market is set up that way. But I think that's the trade in credit, is you play defense here, you wait for opportunities to buy. Remember, the technicals are great. As rates back up here, even though it does put fundamental pressure on companies because their interest expense will continue to go up, man, the technicals are great because companies will issue less debt as rates go up. And we are seeing kind of record demand from international buyers just in the last few days, Mohammed, into our credit markets here because the all-in yield is so attractive relative to, notwithstanding the UK, relative to almost any place else in the world. Look at, Chinese yields are falling, right? European yields, we have, our yields are twice the yields in Europe. We're 4 times the yields in Japan. I mean, our market is really attractive from an international perspective in fixed income.
Mike, we're less than 8 minutes away from this jobs report, and you are setting it up with such drama that I absolutely love it. You're welcome anytime. Basically, are you saying that this could be a really significant move in the bond market across the board if we get some sort of downside surprise? Can you give us a sense of how, I don't want to say violent, but significant the move could be if we do get some sort of significant downside surprise?
I mean, you can get a big move either way. Like I said, the bond market is a little bit on a knife's edge here, right? I mean, the bond vigilantes, as we've seen in the UK, are at the ready to kind of hit the markets here if growth or inflation continue to go up, or the fiscal situation just continues to look really, really tenuous, as we've seen in the UK. So it could go either way. But again, with only one Fed rate cut basically priced in for the rest of our lives here, Lisa, I mean, wow, if you get weakness in jobs at some point in the next few months, and weakness in inflation at some point in the next few months, I mean, that one Fed rate cut could turn into 4 really quickly, right? So that's the kind of value, I think, that's in the bond market today. You could have a 50 basis point retracement in yields really quickly at some point in the next few months. So I just think that's where the skew is positioned right now.
Violent is exactly what Lisa wanted to say, Mike. Mike, appreciate your time as always. It's good to see you. Mike Collins of PGIM. It's what you wanted to say.
Okay, you just keep putting words in my mouth.
It's your word.
Well, it was significant. I don't want to make it sound violent has a negative connotation, but it could be really positive.
Let's put some Wall Street language on.
Okay, thank you.
I think a lot of guests believe that risks are skewed asymmetrically towards lower yields.
That's very diplomatic.
Because of what positioning looks like right now, right?
That's basically what he was saying, is that essentially one rate cut priced in for the remaining lifetime. I just think that his point, though, on the knife's edge is important, and that you could see a significant move in either direction is one that highlights the vulnerability and the volatility that's baked into this market.
Mohammed's warned about this a million times over the last several months. Credit to you. We are hypersensitive to incoming information. Whatever this number looks like in 5 minutes' time, we will build a massive narrative and extrapolate it out 12 months. And you'll see the market do the same, won't you? Almost immediately.
Yeah, and then we'll remind ourselves that these are very noisy numbers and we shouldn't get carried away.
And then the Federal Reserve will respond to it at the end of this month and do what?
I have no idea. Good luck. I don't know. We're not sure.
Good news for them is that they don't have to put out forecasts,
That's true.
right?
Well, but this is part of the difficulty, right? We don't have a sense of their reaction function to incoming data. Is it just noisy? Is it something that indicates a real shift in narrative like we saw from September to December from the Federal Reserve?
And what's more important to them, today's report or January 20th? The first few steps that we get from the incoming president?
I actually think that for equity markets, it's actually incredibly important that we see a strong number. And that, I think, is going to be one of the more interesting surprises. Do we have an undermining of the American exceptionalism story if we get some weakness in this number that might be really wonderful for the Mike Collinses of the world, but maybe less so for some of the others?
Michael Hartner of Bank of America said a Goldilocks December report of 125 to 200 is needed to hold the 30-year yield below 5%.
Interesting.
So we'll see.
125 to 200.
That's quite a range, isn't it? It's quite a range. Up next on the programme, it's the big one. Mohammed throwing shade at the south side. That will continue. The jobs number just around the corner. 165 is the median estimate. The number drops up next from New York. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It all comes down to this. You know how this works. The most important jobs number since the last one until the next one. The median estimate in our survey, 165. The previous number, 227. Equity futures into it, negative 0.2% on the S&P. On the Nasdaq, down by 0.3. In the bond market, your 10-year just about stable through this morning. Yields unchanged at 469. And the world in foreign exchange, watching what this number will be. With the number, let's cross over to Mike McKee. Good morning, Mike.
Good morning. Well, it looks like at this point you can turn your attention to CPI because the numbers come in pretty good for the Fed staying on hold. Change in non-farm payrolls, 256,000. That doesn't suggest that there's weakness in the economy, nor does the unemployment rate number, 3.9%. So that's average hourly earnings. Excuse me, the unemployment rate number down to 4.1% from 4.2%. 3.9 would have been pretty amazing. But it is 3.9% for the year-over-year average hourly earnings, so 0.3 on the month, which is a little bit less than last month. So it looks like we're seeing a little bit less wage pressure. We're still seeing strong growth, and we're seeing an unemployment rate that is stable to falling a little bit, and that's going to keep the Fed pretty much on the sidelines for the coming month, I believe, unless we get some surprise next Wednesday.
Mike McKee, big move in a market. Let's get straight to it. Equity futures gapping lower. We're down by about 0.75% on the S&P 500. Push it through the bond market. Take a look at this. Up by about 9 basis points at the front end of the curve on a 2-year. On a 10-year, up by 8. We're approaching 480 at 477. I talked about what was happening abroad. We've got to look at foreign exchange worldwide. Everything weaker against the US dollar, including the euro and pound sterling. Cable down to 122, the euro back to 102.50. I had a quick look at the gilt market for you. I'm sure the Treasury of the UK is sitting there with its heads in their hands. The 10-year in the UK up another 7 basis points to 4.88. Lisa, it's a big surprise on payrolls, upside surprise on payrolls in America.
Which is not certainly what the UK wanted to see, nor necessarily some of the officials in Germany and elsewhere. I do want to point out, though, for equity markets gapping lower, what I find interesting is this is actually a statement of strength when you take a look at private payrolls, which came in at 223,000, up from the estimate of 140,000. This is being driven by the private sector, and it's not necessarily being accompanied by major downward revisions. This is strength, and it really goes to the question of accelerating inflation and growth.
Getting closer and closer to 5% on a 30, on a 10-year, 476. The jobs number, if you missed it, comes in at 256. The median estimate was 165. The unemployment rate has come back down to 4.1%. We were looking for that to stick at 4.2%. And the obvious reaction in markets, bond yields higher, the dollar stronger, equities a little bit lower, down by 0.8%. Mohammed, you've had a few minutes to go through this. What do you think about this one?
I think this one's good for the economy. I know how the markets are reacting, but fundamentally, this is good for the economy. It confirms 2 things. One is the economy remains solid, and 2 is the U.S. continues to meaningfully outperform other advanced economies. And that theme of dispersion is going to become really important as we go forward.
How does this complicate the lives of people in the UK? And by people, I mean authorities. Authorities in Europe, in Japan, who are just seeing repeatedly really strong numbers come out of the United States.
Yeah, I think they have to hope for something better, but recognize that they have domestic issues that get amplified in a meaningful way if yields continue to go up due to the U.S. What they cannot do is simply blame the U.S. and stop there. They have actually got to get their own act together. And this is more about them than it is about the U.S. I know the U.S. is leading the higher yields around the world, but when you expose people's weaknesses around the world, these need to be addressed.
The idea of the Draghi report, and I'm just looking right now at the euro, and it's dropping like a stone. Talk about parity. We're at 102.24, and this goes to this question of, do they get some sort of reform or energizing push into their tech sector, et cetera? The fact, again, I keep going back to this, and Mohammed, you're exactly right with the idea that this is unabashedly positive when it's being driven by the private sector. This is not government spending. So those discussions really have to change, which should be positive, maybe for the U.S., but the rest of the world.
I mean, the worst thing is to lose the only locomotive of global growth. If we lose this only locomotive of global growth, actually things get worse in the rest of the world. So the U.S. has to continue to be strong, but the rest of the world has to get its policy act together.
I believe Mike McKee's still with us, so let's cross back over to Mike and get a second look at these numbers. Mike, you've had about 4 or 5 minutes to pore over it. Big upside surprise. What's driving it?
A big upside surprise. It looks like we're getting numbers for things like retailers, manufacturing lost jobs 13,000. Construction was only up by 8. So an issue there. But the retail trade gains 43.4. So 43,400 jobs there. And of course, additional jobs in leisure and hospitality, of course, as always. Healthcare up 69,500. That's kind of what we normally see. At leisure and hospitality up 43,000 in terms of that. Food services up by 30,000. So it continues the pattern that we've seen, but stronger for all of these things. Now, in terms of the unemployment rate, a big rise during the month in the establishment hiring. And remember, there were people who were worried about that last month, that they thought the establishment numbers were bad, and therefore we were going to have a problem. But they go up by 240. The labor force goes up by 243,000, and the number of employed people in the household survey up by 478,000, while the unemployed number fell by 235,000. So more people joining the labor force, but more of them getting jobs. All in all, Mohammed is absolutely right. This is good news overall for the U.S. economy. And it will be very interesting to see, here's my one political comment for the day, how President, then he will be President Trump, talks about the U.S. economy in his inaugural speech. Remember, last time it was American carnage. This is a long way from that.
Well, Mike, I'm sure he can turn around and say that some of these numbers, Lisa, are off the back of improved confidence from businesses to hire, going into what many people believe will be a pro-growth administration for the next 4 years.
I actually want to think less about the political spin on this, and I want to look more at just the actual numbers and just how sustainable they are. Does this call into question the fragility and the frozenness of a market that, as Mike just described, included more household survey hiring, lower actual people who are coming out of the labor market, and if you take a look at the participation rate staying pretty steady, even coming in. So to me, the underemployment rate's actually coming down, all pretty unabashedly positive.
5% watch on a 30-year. I know you're on 5% watch too, 498. 498 on 30s right now. The 2-year right now up 10, 11 basis points to 437. With us around the table, Stephanie Roth of Wolf Research. Stephanie, good morning.
Good morning.
That's quite a number. What do you make of it?
Sure is. I mean, first of all, it's quite a number, but average hourly earnings were 0.28. So this is kind of a Goldilocks type of report in a way. Of course, markets are trading it as a hawkish print. But the reality is that wages are growing at below 4%, even with job gains running this strong.
So we don't have to start talking about interest rate hikes anytime soon at the Federal Reserve?
I don't think we have to be talking about hikes, but we have to start thinking about when is the Fed going to be pausing. That's the real question.
Well, now, I think that's what people are saying, right? They're on pause, period. I think the question is just when are they going to revive? I want to go to the point that you're making about inflation, and that this does sort of question just how much inflationary pressure is under the hood of some of these gains. How accurate have the average hourly earnings actually been when it comes to inflationary pressures? Because ultimately, if people have jobs, they have been shown the willingness, particularly of millennials, in paying premium for premium seats on airplanes and other things. I mean, there still is the impetus to spend if you have a job.
Yeah, I mean, it all comes down to the labor market. If the labor market remains healthy, then people are going to go out and spend. The thing is that wage growth is still running, that 4%, which, given where productivity is, the Fed can kind of accept something like that. So, and the Fed has said this a couple of times, that they don't believe that the labor market is really causing significant inflationary pressures. So now the question is just that can the Fed stay on pause from here, or can they cut 1 or 2 more times?
So Wednesday's ADP numbers on earnings showed a difference between 4% wage increase for those who are on the same job, 7% for those who are changing jobs. And the question becomes, if we continue to create so many jobs, if vacancies are already at a 6-month high, at what point do earnings become the lagging indicator? At what point do earnings respond to what's happening in terms of the quantity of jobs?
Yeah, and that's the trend that we saw, in 2022 and 2023, and the labor market started to heat up. There was that differentiation between job switchers and job stayers, and that is something to keep a close eye on. But as of now, the wage data have been fairly contained. And if we didn't see a wage price spiral in 2022 and 2023, it's very unlikely we'll see it this time around. That was the real strength in the labor market, and it didn't really unfold into something that was out of control, wage inflation. So this time I don't anticipate that will be the case. To get to your question earlier, how accurate is the wage data from month to month? Not great. This probably had some calendar effects that pushed down some of the data, But on a year-over-year basis, it's in line close to what the ECI is saying, which is kind of the gold standard anyway. So I would say, you know, yeah, maybe it was artificially depressed by some of the calendar effects, but the reality is wage growth is running at something close to 4%, which is somewhat tolerable for the Fed.
So how confident can we be that we don't get the second round effect? Because some economists will tell you it's not surprising we didn't get in 2022, 2023, because people had no memory of inflation. So they didn't think that they needed to adjust. Now, 3 years later, people have a fresh memory of inflation. So can we be as confident that it's just a one-off? We don't get the anticipatory wage demands. We don't get the anticipatory price increases.
I mean, and that's going to be the challenge for the Fed, which is probably why they're going to have to sort of wait this out for a little while. And with tariffs, of course, that makes it a little bit more challenging. But I think at the end of the day, we'll see that the inflation is probably going to stay sticky somewhere between 2 and 2.5%, but I don't think we're risking 3, 4, 5% like we saw last time. So I think this challenges the narrative that inflation is going to easily get back down towards 2%. But something that we saw the last time has to be driven by supply chain issues, which we currently don't really have.
If you are just joining us, welcome to the program. Just moments ago, a big upside surprise on a payrolls report coming in at 256, the estimate 165. Unemployment dropping back as well to 4.1% from 4.2. Off the back of that, some big moves in the bond market, particularly at the front end of the curve. The 2-year up by double digits. Off the back of that, as you might expect, some dollar strength. Euro dollar getting closer and closer to break-in 102. And if you check out the equity market, equity futures down across the board. On the S&P 500 down by 0.8. On the Russell, the small caps negative by 1.7%. We'll see if all of this sticks. We are on 5% watch on a 30-year yield. Lisa, the high of the session, 499.81.
And we're pushing back the potential for our first rate cut of 2025 from the Federal Reserve to, at one point, October. Now we're back to September, but really pushing it back. This is where we start to wonder, particularly in the small cap area, how much this becomes restrictive for a small subset of companies. And I think about housing, I think about mortgage rates, and how much that can remain dissonant from the rest of the strength from elsewhere before, you know, it actually calls into question some of these dynamics.
Joining us now is Jeff Rosenberg of BlackRock. He's got thoughts on this market, I'm sure. Jeff, first of all to you, sir, and welcome to the program. Your reaction to that number from 12 minutes ago?
Yeah, well, clearly it's a strong number, and that's the market reaction. That's the first point. Second thing is the retail component here. It's worth kind of like thinking about what's going on here. So it's having kind of an effect in two parts of the report. The retail numbers underlying are stronger because of the shift between November being negative because of the lateness of Thanksgiving and Black Friday. So you're seeing a little bit of a flattering on the headline number. The other thing is that average hourly earnings, which your last guest was talking about, which is kind of like it's maybe not so strong. We don't have to worry about inflation because it's, a weaker average hourly earnings print. You got to be careful. And the question was, how reliable is it? On these monthly payroll reports, the problem is the mix shift really can mess with that number. And the boost to retail this month may be factoring in. Those tend to be lower paying jobs. And so it may be actually understating the average hourly earnings, which if you didn't have that mix shift, this may actually be even a stronger picture, which is then the third point. This is just financial conditions tightening because it's less need for the Fed to cut. We've priced out most of that. Most of that shift happened in the FOMC December meeting, but this is even further pushing it along the way. Now, Jonathan, you asked, does that mean, when do we start talking about the Fed having to hike rates? No. This is pricing out any need for the Fed to be cutting and pushing on my longstanding, refrain every time I come on the show is just financial conditions are really undermining the Fed's view that their policy is really that tight. And so they don't need to be worried about how tight their policy is. And so this is pricing out some of those future cuts for 2025. Not that we had that many priced in to begin with.
Jeff, you've asked and answered most of the questions that we had. So I do want to go to this question of what do you do with this, right? I mean, does this make you more bearish on equities, or does it actually make you more bullish? Because ultimately, you're not going to find the value in fixed income. It is going to come from the growth and the strength that we just saw reflected.
Yeah, and you touched on it as well. You know, it's a good report, and Mohammed's first point was like, hey, this is good news. This is American exceptionalism. This is a strong economy. You know, that should be good for stocks and risky assets, and I think that ultimately is the case. I think the market and the valuations have to get over the idea that you're facing some higher interest rates. I think from the fixed income lens, the higher interest rates are actually bringing value, relative value, back to fixed income. You know, we've really shifted the pricing of how much do we need the Fed to support. You talked in the earlier segment about the asymmetry. I very much agree with that the asymmetry is now kind of more in favor of fixed income in terms of how much more rates can go higher versus the potential for them to go lower. And we priced out a lot of that expectation of the support from the Fed, and I think that's helpful to the pricing of the bond market. And the kind of the sell-off that we're seeing here in the front end, you know, leading, I think that has reinforced the attractiveness of yield in the front end of the yield curve.
Jeff, it seems that we're very comfortable with the notion that this pushes back whatever rate hikes, who rate cuts we're going to get, and we're going to get fewer, et cetera. But the minute someone mentions a rate hike, everybody gets really, really uncomfortable. Say, no, we're not there yet. What does it take to get there?
I think it takes a lot to get there. I mean, that's a very big swing. And obviously what it takes to get there, Mohammed, and you know this, is it's inflation. And not just like the somewhat unease of sticky inflation, but a complete change in the narrative that for all the forecasting of the underlying components and the imputed data and our understanding of inflation, that we've just gotten that so wrong, and there's a reacceleration in inflation. I think you have to have a reacceleration, not the slowing in the movement to 2% to shift the Fed and the market's expectation that this goes to tightening. I think it's a very high bar to get there, and we're really just pricing out the last few expected cuts in 2025.
Well, Jeff, let me put it another way then. How high is the bar to cut again, given what we've just seen over the past few months?
Yeah, you know, I don't think the bar to cut again and to change the expectations on cutting is that high either. I mean, look at what we went through last year in terms of the swings in market expectations on what the Fed would do, and the Fed's own forecasting on what it would do, and the extreme data dependence here. So the bar to more cutting is we're seeing that stabilization in inflation. There's not the risk on inflation. And for whatever reason, obviously not the story today, you're seeing that slowdown that the Fed has feared in the labor markets. And a couple of data points on labor markets, again, not what we're seeing today, sub 100, pictures, increases in unemployment rates. You get 2 reports in a row of that. You could very quickly shift the narrative back to, the Fed's got to cut 2, maybe 3, because of this extreme data dependence that we have the Fed driving market expectations.
I see Stephanie Roth nodding along. I do want to just point out that briefly, the 30-year yield did hop above 5% before coming back down, but it's right now 4.9 up. There it is, 5%. Once again, you're shaking your head. Do you agree with what he's saying?
Yeah, I agree. The Fed's been data dependent, but like very much on every data point, right? So to the extent that we have another couple of prints that are a little bit softer in the beginning part of, in the next couple of months, then the narrative could shift to some extent. We've seen every 3 months the market has been swinging from soft landing to hard landing to no landing, and realistically, you're probably somewhere in between. So base case at this point is the narrative is going to continue for a while. Then you're going to have the Q1 inflation seasonality problems again. So it's probably going to be towards the middle part of the year when we could start talking about potential cuts again.
So Stephanie said the Fed is data dependent not only overall, but to every single data point, which of course Powell would push back on you and say, no. And that makes us all data dependent, right? And it makes us all add volatility to a market because we get swung around. Doesn't that bother you? Doesn't it bother you that everybody has become so data dependent?
It does. Nobody should be caring about the unemployment rate to 3 decimals and average hourly earnings to the same kind of thing. I just had that conversation with Tom Keene earlier. It makes us uncomfortable, but we all have to. We all are in this environment, even though they're trying to steer us away from that in theory. The Fed continues to get swung around by every data point, so then we all have to focus on the same thing and figure out every nuance within every single print. The retail thing is a good point in the sense that it was minus 29 last time, and now it's jumped back up 43. realistically, that drove some of the strength, and you probably should smooth that out. But we're in an environment that it's going to be tough. And by the way, next print, we're going to be impacted by all of the fires, and that's going to be a really messy data point as well.
Can you think of any Fed that got swung around as much as this Fed is getting swung around? I mean, I think back of the financial. I mean, I think back of so many bigger episodes.
Mohammed, I go post-pandemic. Post-pandemic, this Federal Reserve allowed the administration at the time to come out with huge fiscal plans in a supply-constrained economy and just say, we'll look through it. We'll look through it. They weren't data dependent then. They waited. The change in behavior on the FOMC, I hear a lot of economists, present company excluded, a lot of economists who are more keen to defend the institution than provide critical analysis of it. That's really problematic for me, for economists on Wall Street who are hell-bent on making sure that their friends at the FOMC still give them access to have conversations at NABE, etc., than actually just calling things out for the way they see it. This Federal Reserve has behaved very differently under Biden and has changed when Donald Trump has come into power. They've opened the door to those accusations themselves with that news conference back in December. Without a doubt, do you agree?
No, I agree that now we have a Fed that's navigating two things: the monetary policy landscape and the political landscape. It's not navigating one thing anymore. It's navigating two things, and we just have to keep that in mind.
Why wasn't it navigating the political landscape 2-3 years ago, when it was clear that fiscal policy was in the driving seat?
I think 2-3 years ago, they were asleep. And the rush to call inflation transitory, ignoring the policy side, ignoring all the uncertainty, was a big mistake. And because of that, they became extremely data dependent. And they don't even want to look forward anymore. And it's ironic because we're dealing with markets that are supposed to be looking forward. We're supposed to be discounting the future, right? And yet we've all become completely dependent on what's just happened. It's absurd, but that is what happens when the institution with the printing press in the basement decides that it will become excessively data dependent. It turns us all into extreme data dependency.
They meet again at the end of this month. We'll get 2 more data points before then. CPI is one, the inauguration is another. What's this news conference, this meeting rather, going to look like at the end of this month?
Yeah, I mean, I think we're gonna. Well, let's first talk about maybe CPI, because that we're looking for something that should be a little bit more soft, something like 0.24% on core, which should be okay. I don't think it's going to change anybody's view, especially after this print. This print made the CPI a lot less important. And then we're going to have to see from the Trump administration, what's going to happen in terms of immigration? That's going to be one of the biggest things that's going to happen probably right off the bat. How aggressive are they going to go? It's probably going to be at a lot of all bark at the beginning, and then realistically we're not going to see that much deportations because that's going to require funding that they don't have, and it's probably just going to be people rolling off the humanitarian parole and TPC. But that's going to be a big thing to watch out for. And then the second is what's going to happen from a tariff perspective. We haven't really heard much specifics. We're rewinding back to the announcement on Canada and Mexico. Are we going to get more of that? Probably not. We're not hearing much of it. But those are the 2 things we're looking out for most from him: tariffs and what we're hearing from an immigration perspective.
Jeff, as an investor who has to take a longer-term, we were just talking about, how do you have any conviction with calls at a time where people are talking about how much the parameters could change based on whether it's CPI or whether it's January 20th and the inauguration?
Yeah, it's really recognizing, the things that you think you can forecast and recognizing the things that are just not forecastable. And we have a little saying, if you can't forecast, and I would put all of the policy uncertainties that were just described in that category, then you have to observe. And so you just kind of know what you can kind of control and know what you can't control, know what you can forecast, know what you can't forecast. Try not to overreact to every data point. But on the fiscal policy, I mean, that is basically the story for the 2025 outlooks is uncertainty and unforecastability. So we're going to have to kind of recognize that, and we're going to sit back, we're going to be patient, we're going to observe, and then, as the information becomes more clear, that's when you can take action in your portfolios. To try to do it ahead of time, I think you just have to recognize that's a very difficult exercise, both forecasting what is going to be the policy and equally forecasting what is going to be the market reaction to that. Getting both of those right is very unlikely, so you're going to have to sit back and wait for the data to reveal itself.
Hey, Jeff, appreciate your time, sir. As always, Jeff Rosenberg there of BlackRock. We'll take a step back and a big deep breath and look ahead to CPI next Wednesday as well as some bank earnings too. Mohammed, just a final thought around the table. We came into 25 thinking about US exceptionalism and global divergence. And Lisa and I have been talking about this for a number of days now, a number of weeks. The extent to which we can keep stretching that rubber band, how far can we take that? How much oxygen is left in that story before we get these negative feedback loops and things start to move in the other direction?
I mean, that's a great question, and I'm not sure I can answer that, but I can tell you that the theme of dispersion is really important because there's a limit to how long you can run a system with significant dispersion. And we have two main dispersion issues, US vis-a-vis the rest of the world. The hope is the rest of the world comes up to the US. The fear is the rest of the world drags the US down. And then within our economy, low income versus the rest. Low income they're struggling right now. We must not forget that. And these numbers cannot make us not also consider what's happening at that end, because at some point that we can migrate up. So the theme we're going to be talking about a lot is forget about averages, look at sectors. And that in the marketplace, we've gone from a market focus to a theme focus, and now it's going to all be about individual names.
Honestly, I'm just looking right now at the euro, touching the weakest since 2022. My question is, strong dollar, how much does it actually start to impede earnings from U.S. companies?
Sets up a big week next week. Stephanie, it's good to see you.
Good to see you.
Mohammed, a special thank you to you. Thank you very much. As we count you down to the opening bell, we're already looking forward to Monday. Coming up on Monday, the lineup looks like this. Neela Richardson of ADP, Chris Harvey of Wells Fargo, Michelle Meyer of MasterCard, and Veronica Clark of Citi. From New York, thank you for choosing Bloomberg TV.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
In case you missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably our focus
fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
It's a blowout jobs number, and good news is bad news for the markets. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, an upside surprise for the labor market. A blowout jobs report puts rate cuts back on the burner. We're going to get the first take from acting U.S. Labor Secretary Julie Su and Rick Reeder, BlackRock Global Fixed Income CIO, in just a few moments.
I think those rate cuts are on the back burner.
I never know what
Not on the burner. Fighting the flames. Speaking of, firefighters make progress on controlling the LA wildfires as the deadly blaze threatens to become one of the most expensive natural disasters in U.S. history.
And it's free speech versus national security. The U.S. Supreme Court opens arguments next hour about the fate of TikTok, just 9 days before a federal law is set to ban the popular social media app. All that and more coming up, but let's take a look at where markets are trading after that blowout jobs print, as we just described. As you can see, red across the board. Bad news is what is good news in the economy right now, and you can see that in the S&P 500, down 1% pre-market, of course, dropping like a stone after we got that print at 8:30. You can see the same reaction in your big tech stocks. You should be looking at the bond market right now, though, because you can see the 10-year Treasury yield knocking on the door of 480, up 8 basis points right now. All eyes on 5%. And Matt Miller, the 30-year yield is already there.
Yeah. Well, the 20 is over 5%.
The 20, but I wasn't going to quote that.
Let's take a look at, this is what it looks like when rate cuts are on the back burner. We thought that we would have a rate cut in March, or at least that's what the market was pricing. Now it's not until October, and the total that the market is pricing for next year is 27.7 basis points in rate cuts, so just more than one.
If it's on the burner, it's on fire, isn't it?
The back burner.
Okay. Anyway, some stocks are watching. Of course, something's moving in the green under the hood, even on a down day. Delta Airlines up 7% pre-market. They beat Wall Street profit estimates in the latest quarter thanks to gains in international and corporate travel. Walgreens soaring this morning as well after reporting an earnings beat driven by higher prices for branded drugs and prescriptions. Investors are still focused on whether the company will pull off a transformational move, such as selling itself or breaking up the business. A lot of eyes on that story. 14% higher pre-market. Constellation Energy, what a deal. Constellation up almost 14% pre-market. They will buy Calpine for $16 billion in cash. Calpine is America's largest generator of electricity from natural gas and geothermal sources. We will talk a lot more about energy in the coming weeks, Matt. I know about that.
Yeah, up 14%. Was the idea that Constellation would have to pay double that amount?
Yeah, originally, I mean, we got headlines 2 days ago, and the number that was being floated was $30 billion. So that got just about halved, which is interesting. But there's been a lot of M&A this week, a lot of optimism about the regulatory environment, too, next year, and a lot of optimism about the economy, not that you're seeing it in the stock market right now.
Yeah. This good news for the economy, and we're going to talk to Julie Su in a moment, acting labor secretary, about it, is really bad news for the markets because the markets want to see rate cuts.
Yeah.
And this means the Fed can pause on rate cuts for longer.
Potentially. And you look at the strong data and the yields that you're seeing now, it's only 10 days into the year, guys. We're already above that 475 mark that we've been watching for, another danger zone, if you'll call it. I feel a little vindicated, though, because finally the discount rate matters, and people might start to look at that level of interest rates as they think about the value of stocks moving forward.
All right, let's bring in our resident expert. Michael McKee joins us on U.S. hiring, accelerating at, 256,000 jobs added Mike, where is all of this growth coming from?
American exceptionalism. This may be in part a bit of a rebound from strikes and hurricanes. Now, next month we'll have the fires to worry about, but at this point it was broad-based. That's the best you could say. Some big rises in retail, maybe sort of a seasonal adjustment issue, but jobs created in the areas that we have normally seen them created: leisure and hospitality, healthcare. Not much in government. Only 6,000 at the federal level, 17,000 at the local level,
which is good.
Which is good, because you can't argue that you need to cut a lot of federal workers in order to keep the economy going. The key number for the Fed, of course, was unemployment, and unemployment did go down by 1/10. That's a rounding situation, and we did have an unusual situation this year in that this month, in that the government revises its unemployment rates for the past year. No significant changes, but the November number was revised down by a few hundredths of a basis point. Average hourly earnings come in down 1/10. They're under control, still above the rate of inflation. So that's good for employees, but it doesn't suggest any inflationary pressure. And look at the turnaround in household employment. Those who made the argument that the economy was weakening looked at household employment in November, and that has significantly turned around in December. It's one reason that the unemployment rate went down. Another is that we saw a rise in the number of people who were entering the labor force, and they all got jobs. Matt, you talked about this right at the top, the impact on the markets. We did go from initially having a March rate cut priced in now to October, and you can see it dramatically there. The change in the Fed funds futures over that time period, just pre and post the jobs report, everybody's changed their mind about the Fed. Be interesting to see what Fed officials who speak between now and the blackout period have to say. There's not likely to be any change for January. So we turn our attention, since this kind of takes any kind of rate cut off the table, to what's next, and that'll be next week: PPI, CPI, and retail sales, and then
big day. The
big day, Inauguration Day. Everything that we have said up to this moment on this program could go out the window depending on what happens January 20th and afterward.
That's true. A lot to look forward to. Great context, as always, Mike McKee. We'll see you in an hour's time. That, of course, is our own Mike McKee. And let's broaden out this conversation, because I'm pleased to say now that joining us is U.S. Acting Labor Secretary Julie Su. Secretary, this is our last conversation together in this specific context. And of course, we're on the heels of a blowout jobs report for the December hiring period. As you prepare to hand off to the incoming Trump administration, would you describe this labor market as a fully employed America? What work is still left to be done?
I mean, there's of course still work to do, and we've said that from the beginning, which is why from the beginning we said the unprecedented crises facing this country required an unprecedented solution, an unprecedented response, including by the federal government, and that's what we have done. And today's numbers, following on the heels of consistent, steady, stable growth, 16.7 million jobs since this president came into office. He is the only president that has had positive job growth every single month of his presidency. And that is what we hand off because we knew that that's what the American people deserved. And we knew that if we focused on what was good for workers first, that we could have a recovery like no other. And that's certainly what this month's numbers reflect.
Yeah, I believe we're looking at 48 months with consecutive payroll gains, and that, of course, is going in data going back to 1939. I do want to talk about the manufacturing sector, because if you're looking for some pain, you're going to find it there. In the manufacturing sector, shedding jobs again in December. What do you think is going on specifically in that industry? Can we draw a line between those job losses to all of the different labor disputes that we've been seeing?
No, I would draw the line to really decades of economic policies, trade policies that have not favored workers and of commitment to jobs, which is also why President Biden came in and said, we're going to invest in manufacturing. As a result, the recovery that we've seen since 2021 is the only economic recovery in this century in which the manufacturing sector actually bounced back from a crisis like the one we inherited. And so there's more work to do. There's no question about it. And we know that workers in states where manufacturing has been the foundation need continued investments. And there's some uncertainty about that because the incoming administration has raised questions about whether those investments would continue. But what we've seen is that doing that, having the Inflation Reduction Act, right, having investments in bringing manufacturing back to the United States, into our heartland, is the right way to build the economy.
One more here on manufacturing here, because both American workers and investors alike are looking for any potential future pains that could come. How much do you see this as a harbinger for future cooling in the labor market, or do you think that this is just attributed to cyclical factors?
Well, I mean, at this point, any sort of change in direction in terms of investing in American manufacturing, right? Investing in the companies who've committed to make things here and making sure those investments result in not just numbers of jobs, but good jobs. Any reversal of that feels like it would be terribly irresponsible. And so, you know, we've certainly seen, again, the growth that we've seen steadily over this administration does not happen by accident. And the reversal of decades-long trends that have not been good for working people also cannot happen overnight. So my hope is that we are handing off the strongest economy in the world right now, and the work remains unfinished, and that commitment to workers, we hope, will continue too, so those manufacturing jobs can continue to come back. And we've seen 2 years of very strong growth in construction. That's non-residential construction. A lot of that is because of the president's infrastructure promises that we've been delivering on. And you got to build the factories before you can employ people in them. So that's still work to come.
Exactly. That work has to continue. Ma'am, I wonder, in terms of the transition, if you've spoken with incoming labor nominee, Lori Chavez DeRaymer, have you had those conversations with her team as part of the transition?
Yeah, my team has been very cooperative. Their transition team has been here on site, and we are in every way going to cooperate, both to make sure that they can succeed, but also to make sure that the strength of the department that we've built up, right, not only to do all these good things we've talked about in terms of job creation and connecting people to good jobs, but also that really basic mission of enforcing labor laws, making sure that every worker gets a just day's pay for a hard day's work, making sure every worker comes home healthy and safe. Those are fundamental responsibilities of the department, and our 15,000 strong federal workers are going to continue that really important work. And so we're cooperating with, following the president's instruction that we make this a very smooth transfer of power.
Well, let's talk, of course, about what the new Labor Department will have to deal with when it comes to extreme weather. You and I have spoken before about the impacts, of course, of the hurricanes Milton and Helene on the labor market, and we're witnessing devastating wildfires underway in California, in the Los Angeles area. How much of an impact would you expect that to have on the January print and the revisions going forward from there?
Yeah, I mean, thank you for mentioning that. You know, that is my home state and my home city. And so I've talked to lots of friends, family members who, it's the human impact of climate change, and you know, it's devastating, right? From wildfires to hurricanes. We've seen that just in the last few years even. You know, part of our job here is to make sure that those workers who go in and do the work during those disasters are themselves paid and healthy and safe in doing that job. It's also to make sure that when communities have to recover, that they get the disaster benefits and relief that they need. And so, again, those are really fundamental, important roles of the department. And we also leave a department that's really strongly poised to deliver on those kinds of things. But it's devastating.
All right, Secretary, we have to leave it there. We really appreciate you taking the time to speak with us on these labor releases over the past several months, and best of luck in your next role. That is Acting Labor Secretary Julie Su. Now, coming up, a strong jobs report backing the case for a Fed pause, bonds being sold across the board. We'll discuss with BlackRock's Rick Reeder. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything.
If you weren't watching this morning, and I'm sure you were, you saw a jobs report so hot that it's driven the 10-year way above 4.75%. That was another danger zone that investors were watching for. We're going to bring in now BlackRock Global Chief Investment Officer of Fixed Income, Rick Reeder, who joins us now. Rick, at the beginning of the year, January 1st, you were looking at that 10-year below 4.6%. Now you're well above 475. What's the new upper bound with the new data we've been getting in? It has been stronger since the beginning of the year.
So, defining an upper bound could be a pretty dangerous phenomenon. This, when you got treasuries, a lot of treasuries are going to be auctioned over the coming months. Listen, I think, we talked about on the show last few months, long end of the yield curve, 10 years on out, it's pretty hard dynamic to actually to want to own them even at these levels. So are you going to see 5%? My guess is the momentum will get there. Question of it's really not about level that brings people in. It's about what is the forward economic progression from here, and do you start to see some softening of the economy to bring the Fed back on the table? By the way, as you all were talking about household appliances and the burner of the background, I think the Fed's in the refrigerator for the they can't cut for certainly March is off the table unless you had significant change from here. And listen, I think the economy's in solid shape, and today certainly emphasized that.
Well, Rick, that brings up a question that I have been posing over the last few days, which is, as we see, yields rise, are they higher because we're worried about maybe policy in the incoming Trump administration, boosting inflation, deficits out of control, the inability to really cut spending? Or are they higher because the economy's on the right track, the economy's strong, and it demands this level of rates?
Yes, I think it's pretty hard to parse what that is. Listen, the rate market, even with policy that will evolve in terms of the interpretation of policy today, at least the near-term policy, and I quite frankly think there will be a pivot point around this, but at least the near term, the markets are going to assess tariff and a deglobalization alongside of that as potentially inflationary. I do think there's a pivot to that, in that I do believe in the thesis that the incoming Secretary of the Treasury has talked about. It's a price level adjustment, and it actually will mitigate growth over the longer term. And quite frankly, I actually think productivity I spent the beginning of this week at the Consumer Electronics Show, which I've never been to before.
Wow.
Oh my God. Oh my God. The amount of AI initiative and productivity enhancing dynamics that are at play are pretty extraordinary. So listen, in the interim, not to your question, in the interim, I think you have to interpret policy as potentially at least moderately inflationary, i.e., was inflation going to run, can you get it below 2.5 in the near term? I think it's hard. And, but I do think that you will see, including, and I think that the incoming president's talked about, can you bring fuel prices down? That I think you'll, I think you'll pivot, but I think that's hard. I think that is a hard story to tell today.
So just to recap, you were in Las Vegas, of course, at the beginning of the week. Now you're in Florida, so you're staying warm.
Yeah.
I do want to talk a little bit more about tariffs and taxes, because we talk about that all the time, of course, on this program and others on Bloomberg. And everything is, a question mark right now. We don't know what's actually going to happen. So is that an investable theme for you right now? What might happen with tariffs, or is this really a wait and see sort of moment?
So a couple of things. By the way, Las Vegas is pretty cold.
All right.
I realize at this time
I don't know
of
if
year,
it was as cold as Manhattan, but
no, that's true. That is true. So listen, is it an investable theme? I think there's a couple things like we talked about. I think how you manage your interest rate exposure going into this, I think, is investable. I.e., you shouldn't be long a lot of long interest rate exposure. I think the dynamics around U.S. and I think the conversation last year was interesting around the U.S. relative to the rest of the world. Listen, the U.S. is a pretty closed economy. Actually, when you take the aggregate export-import dynamics, the numbers are pretty large. However, the economy actually operates amazingly well independently, not very much unlike China. It operates very much unlike Europe and Germany, et cetera. But it operates pretty darn well. You've got a consumer that's in really good shape. You've got domestic capex and R&D spend that are incredibly buoyant. And so, listen, I think the U.S. economy, you think about, the story of, is it now time European equities are cheap enough? Chinese equities is a tough trade. I think U.S. is, particularly, some of the mega cap. And, when you get, points like today where you get some dip in the market, U.S. investing in U.S. I think is still pretty significant. Listen, I also think, there's some domestic businesses that are, that will participate, and you'll see some resurgence in terms of investment in U.S. As you start to bring some jobs and some business back to the U.S.
It's interesting. Matt and I are mind melding right now, too, because I'm the annoying person on the show, Rick, who always wants to take the other side of the argument. Even in such a strong economy, you're looking at private equity bankruptcies hitting an all-time high, according to S&P Global. You're watching general bankruptcies also reach the highest levels in more than a decade. So it's not all rosy under the surface. And
700 companies in the U.S.
And some of them are quite large. What does this mean for somebody who is looking at credit across industries? Do you find that there are pain spots?
So I think it's a great question, and I actually think today is a really good day to address it, because you look at the employment report today, and you look at it's services, 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 and then you look at and you bifurcate into look at manufacturing. The world is shifting. And by the way, you look at things like I was just looking at Delta Airlines earnings. The world is moving in a very different direction in terms of technology, asset light, less manufacturing, less. There's a little bit of we can talk about construction as a mixed dynamic to it. It's services, services, services. Industries are changing. If you said to me today, do I like the high yield market? I like the high yield market. But do I need to own a lot of triple C's today, particularly with the risk-free rate, with interest rates high? But I don't. But in U.S. and Europe, where I actually like buying credit in Europe, that with these yields, you can stay in double B and single B. And you think about in that part of the credit markets, they've termed their debt out. The economy's operating really well. The free cash flow generation is still quite buoyant. But I think your point is very well taken. There are parts of the ecosystem that are having a problem because of these interest rates that are too highly geared in parts of the leveraged loan market, and B, industry is shifting, and if you're in a heavy industry, hard asset business, pretty hard today. Plus, by the way, some of the industries, I would say media, telecom, that did a fair amount of gearing at lower interest rates, that there will be defaults there.
Well, I'm glad you brought up your high yield positioning because I take a look at BINC, which is the ETF that you run, and it's really interesting to see 38% of your weighting is to high yield corporates. And then within that, 17 to 18% is towards European and pound-denominated high yield. And we talk to a lot of bears on European markets, both in the fixed income and on the equity side. So it feels like you need a strong stomach to have that sort of weighting there, Rick.
So I think a couple of things. First of all, this gets back to this question of I like being an equity investor in the U.S. I like buying the bottom part of the capital stack oriented to growth in the U.S. I like being a lender in Europe. And there is a bifurcation in Europe around, do I need to take a lot of triple C down the curve? And by the way, in Europe, do I have to take a lot of even weaker single B? You could be in the double B zone, and because of the cross-currency basis, you swap back to dollars and your yield is pretty attractive. So honestly, I've been doing credit for too long. Honestly, I actually think when I look at companies and I look today and I say, you got cash flow, it's a good place. You've termed your debt out, and it's a pretty, and as long as the economy's in a pretty good spot, and you're not 6 times, 7 times, 8 times levered, boy, I feel pretty good. I sleep pretty well at night in some of those credit markets. Much more so than in the past.
Rick, we need some free advice. A viewer writing in and asking, at what 10-year yield level would Rick Reeder be interested in longer duration? Just got 30 seconds, but help us out here.
Matt, I think you asked that last one. I said I'm not going to go there. I think I think it's. I think it is all. Do you start layering in as you get to a 5 handle in 10 years? I think so, but honestly, I think we're creating, we're talking about BINC. If we can create 6.5% yield and stay in the front of the belly of the yield curve, not take a lot of interest rate risk, just keep clipping coupon and let other thrill seekers play in the back end of the curve and pick the bottom, good luck. I just think the economy's.
I swear to you, Rick, this is a viewer who wrote in this question. I'm not just repeating my question. So
Matt, can I know you got to run?
Unfortunately, we only have 10 seconds. We're running up against a hard break, but I really appreciate Rick Reeder there, BlackRock Global Chief Investment Officer of Fixed Income. This is Bloomberg.
In this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that. Not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's brutal out there today in the equity markets. 20 seconds to go until the start of trading. This is Bloomberg Open Interest. You can see the drops not quite as bad as they were right after the non-farm payrolls print. We had 1% plus drops on S&P futures. Now we're only down about 2/3 of 1%. NASDAQ futures down more, about 0.8 of 1%. Russell futures, they really need a cut. And so Russell 2000 futures are down a lot more. In terms of what's going on the stock exchange, God's love we deliver, ringing the opening bell. I think it's an appropriate time for that as we see the tragedy continuing in Los Angeles with those fires burning 10,000 structures, creating maybe $20 billion in insurable damage. Anteris Technologies down at the NASDAQ as they list on the tech-heavy index. I think they have another listing, but they're moving one over to the NASDAQ. In terms of the major averages, after we got that blowout, good news for the economy print on non-farm payrolls, Katie, adding 256,000 jobs, you really saw futures drop. And what are we looking at in the live trade?
Well, like you and Olivia Rodrigo said, it is brutal out here. The S&P 500 down by about 0.8% if you round up a little bit. That's off the worst levels of the pre-market session, but still red on the screen. We're set up for a second consecutive week of losses when it comes to your big benchmark. Similar story if you take a look at the NASDAQ 100 down 0.9%. I want to highlight the small caps, the Russell 2000. I always highlight the small caps, but particularly today because, Matt, like you said, this is an area that needs a cut. If you take a look at 12-month forward EPS estimates for the S&P 500 for the small cap index, going in different directions right now. So we'll continue to keep an eye on that. But let's get to some M&A news, and that is in the form of Constellation Energy. The confirmation coming today that they will buy Calpine for $16 billion in cash. Calpine is America's largest generator of electricity from natural gas and geothermal sources. Bloomberg News reported this earlier in the week. We get the confirmation today, the price tag being slashed in half from the early reporting. Maybe that's why you actually see the acquirer here up about 18.5% right now, Shanali.
People love deals, and people love impending ones, too, pending ones. Walgreens Boots Alliance, this is a stock that was down 84% last year. It's soaring this morning after reporting an earnings beat driven by higher prices for branded drugs and prescriptions, but investors are really focused on whether the company will pull off a transformational move, such as selling itself or breaking up the business. Walgreens Boots Alliance shares up 20%, 21% almost at the open. Executives also talking about potential deals for certain units this morning as well.
Delta Airlines, also one that we're watching, beat Wall Street profit estimates in the latest quarter. Thanks to gains in international and corporate travel, the CEO, Ed Bastian, expects strong demand through 2025. So, you know, there are not many places to buy a plane ticket these days.
That's true.
I guess Delta is just one of the few.
And Ed Bastian, he's jazzed about demand, but it helps that fares are going higher as well, at least, you know, if you're an airline. If you're a consumer, maybe not as much.
The load factor is just huge, right? When I was a kid, it was like 60, 65%. And now you're looking at load factors 80, 90%. The plane is just full.
The plane is just full, yeah.
Oil prices back on the rise this morning as well. You have to wonder what that upper bound for pricing is when maybe there are some under the surface pressures in pricing, if you will. And plus, they like it that those prices are rising. Just what's the upper bound there, too?
Yeah, we'll see, of course. Delta Airlines up nearly 7%. But let's broaden out this conversation and get back to that news that we got at 8:30 a.m. this morning, that the labor market, at least in December, super strong. We'll bring in now Seema Shah. She is Principal Global's Chief Global Strategist, joining us now. And Seema, if you look at the reaction in markets, the answer has been to sell everything from stocks to bonds after, of course, that blockbuster jobs print we got. Do you think that that is the correct reaction here?
Hi, Katie. Well, I think it's a reaction that we should have expected. If you just think back to December with the Fed press conference, when Powell almost sounded like he was making a case for a hike, even as they were cutting rates, the way that the market reacted gave us a kind of a clue as to how the reaction would go today. Now, I think coming into this year, we have to remember, look, equities were priced for perfection. They had just about made their peace with the idea that the Fed could cut just twice this year, and now you've got this push up in yields. You've got the market pulling back even further on that 2-cut expectation down to 1, if not less. And it's something that the market can ill afford at this point. The thing is that when you're looking at over a longer term trajectory, it's worth remembering that if there's strong economic growth, it means strong earnings growth. And that's really key for equity. So I think this is a challenging moment, but I think it should reverse and there should still be biased higher as we look to the rest of 2025.
We got obviously a blowout number, but it's seasonally adjusted, right? If you take out that adjustment, it's a drop of more like 100,000 jobs. Plus, you've got the labor force contracting over the past few months. I think contracted by 220,000 jobs in October, another 193,000 jobs in November. It continues on that path. Aren't you going to have to pay your workers a lot more? Isn't labor, I mean, Shonali just mentioned oil prices rising. Labor costs are going to be rising as well. Are you worried that we see real pickup in inflation in 2025 that leads to the Fed not only not cutting rates, but also considering raising them?
Well, I think you make a good point. The inflation risk is probably the most pertinent risk for markets, for the economy for this year. And it's not just from the economy, as we know, as we've discussed many times over, I think, in the last couple of months or so. It's about what the new policy the administration is going to do to policy, especially with regards to tariffs. So everything at the moment is probably leaning to upside inflation risks, and it would put the Fed in a really, really tough spot. I would think that ultimately the hurdle for higher rates, at least higher Fed rates, is quite high. But certainly if they get to that point where they're looking at a second inflation wave, the economy is strong, then I think that those interest rate hike forecasts start to really come back into play.
One question I have about the direction of interest rates is the spillover to equity markets. You had for a long time the discounted cash flow model really mattering here. This idea that future cash flows would be impacted by higher interest rates, that would be calculated as a lesser thing. It feels like, Seema, tell me if I'm wrong here, like the market has ignored that kind of thinking for the last year or so. Where in the market does that matter again? Is it limited in scope to, say, the small caps?
Well, so I think it hasn't been as important as what we would historically think, that's for sure. But I think we've seen in the last 2 months or so of 2024 that the equity market was really going an uphill battle. It was kind of an uphill struggle to get those gains when you had bond yields moving higher. So I think the struggle's been there. It's just that when you have got such a strong economy, when you've got earnings growth looking as promising as they are, plus an administration which is coming in with a deregulation bias, that means that equities can continue to push through. But of course, that can only go on for so long. And when you get to this level of 475 for 10-year Treasury yields, it's really the calculations for investors start to fall heavily into fixed income's favor. Now, from our fair value models, we would suggest that bond yields, they're not quite at the top, but they're nearing that peak. So at that point, that maybe then yields start to come down, and assuming that the Fed does actually continue to cut rates this year, and that's the key assumption, then we think that it should pull back in towards equities. But it is a very, very important question for sure.
Well, it's interesting. I mean, to build on that, one of the reasons I hear for why some of those DCF models don't exactly work in this market is because it's Magnificent Seven heavy. Of course, you have all these big tech names that aren't relying on those distant cash flows. They have a lot of short duration assets. They have a lot of cash right now if you take a look at some of the big tech names. So maybe that logic falls apart there. And Seema, you've told me in the past that when it comes to that cohort of the market, that in some senses, they're a bit macro agnostic. Is that still the case?
I think it is still the case to a point. Right, so I think those Mag 7, the earnings growth, the way that people look at them, investors either looking at them as almost like a safety trade of something which we know is going to be resilient even as the economy weakens or if the economy weakens. or maybe just looking at it in terms of the long-term earnings growth and continue to be attracted there. They are macro agnostic in that sense. But ultimately, there's always going to be some kind of pressure. Now, the pressure is going to be significantly deeper for small cap equities, for anything which is more interest rate sensitive. But I think nothing in the market is completely immune. It just means that those Mag 7 are slightly less vulnerable than the others.
We keep on asking investors the upper bound of the 10-year. A lot of investors, we had Rick Rader, not really willing to call the upper bound, which says to me that there are a lot of risks around the surface that could take that 10-year a little out of control. You think fiscal risk, term premium, you name it. What's your upper bound? Do you have one?
So, again, I think like anyone wants to be, it's very difficult to put a forecast on anything at the moment because of, the wide variety of uncertainty out there. Now, I think a 5% level is not completely out of the question if you're going to continue to see strong economic numbers, maybe another hot inflation print next week. I think anything is possible, particularly when you have a global bond sell-off. And we have to remember that it's not just about the US at the moment. There is volatility across so many economies, and that momentum is going to be adding to it. Whether or not that 5% level, if it hits that point, can be sustained is probably another question. And I think a lot of it will still come down to what the Fed is going to do. What are their voices going to be saying over the couple of weeks?
We will be paying close attention to that. Seema, thanks so much for joining us. Principal Global's Seema Shah there talking to us after a blowout jobs number drives yields higher and stocks lower. Coming up, firefighters making strides to contain the deadly fires in Los Angeles as damage estimates climb to $20 billion. Details next as more than 10,000 structures are lost. This is Bloomberg.
So a number of people, I think, from Homeland Security and or the CIA or NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements. And TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
All right, welcome back to Open Interest. You're taking a look at the stock market right now. About 14 minutes into the session, it's still ugly out there. The S&P 500, the NASDAQ 100, the Russell 2000, all lower on the day. I put on Bitcoin, though, because if you're looking for a safe haven, you're not going to find it in the bond market, but you'll actually find it in Bitcoin, up about 2% right now. I will note that gold is also higher, but not by as much, so we'll watch how this one develops. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Barclays upgrading Snowflake to a buy. The firm is optimistic about the software company's pipeline, saying that the new products address the latest AI trends. Next up, we have Lululemon getting upgraded to a buy over at Needham. The firm sees potential for re-acceleration in U.S. demand after signs of a strong holiday season. And finally, we have Roku getting downgraded to sell over at MoffettNathanson. Geez, that's a tongue twister. The firm, it says that the market is too optimistic about the streaming video company. It says that the stock is massively overvalued, maybe a little bit less so today, Matt. Shares down about 3.8%.
It is fairly difficult to just rattle off MoffettNathanson.
I'm going to practice this weekend.
Yeah. All right, let's shift gears to something much more serious. Tragic fires in Los Angeles continue. The firefighters there are making progress in getting the deadly blaze under control. 4 of the 5 major fires in the region are showing signs of being contained this morning. President Biden is increasing federal assistance to California to combat those wildfires, urging Governor Gavin Newsom to spare no expense. The president also announced 400 additional federal firefighters and over 30 firefighting helicopters and planes to support California. The problem there is if the winds are so high, it's really difficult to get those birds in the sky. The damage being done is being felt in markets as well, particularly in insurance stocks. Here's a look at Allstate, Chubb, and Travelers this morning, all down materially. Bloomberg Intelligence estimates insured loss assumptions have risen to a minimum of $10 billion and could be $20 billion. Bloomberg Intelligence senior analyst Matthew Palazzola is leading that coverage and joins us here now on set. So, Matt, you have to, I guess I saw you updated your estimates this morning, continue to move them higher and higher. Now that they've got the fire under control, do you feel comfortable at this level?
So I'd say this. I just checked CAL FIRE. It's about 6% contained. So, it's not.
I meant slightly under control.
So to answer your question, yes, they can go higher. What has been surprising is the speed with which structures are being destroyed. So within one day, we got reports of 1,000. Within 2 days, we're getting like up to 5,000 destroyed. And that's pretty unprecedented for something this big. With home values that high as well. So that's why it's kind of pushing these numbers higher and higher.
When you think about the damage being done, 1,000 structures, you have some really interesting details in your report as well about what context that has relative to other fires we've seen in the region. But bring us a little under the hood here. What are all the types of structures being damaged right now, and what can't be seen again? I mean, there are people's homes completely destroyed and other critical infrastructure for the state.
So I think as of now, it seems to be mostly homes. You will see those rebuilt, I believe, right? I don't know every detail of every neighborhood, but typically what happens in these events is that they do rebuild their homes. The infrastructure will definitely get rebuilt by the state or federal money. But as of right now, in our analysis, is really focusing on the homes that are being destroyed.
Let's talk about some of the specific insurers, because you mentioned Chubb, Allstate, and Travelers, that these are large, but manageable events for these public insurers. What were the fundamentals of those companies looking like heading into this event?
Yeah, fundamentals pretty good for insurance companies going in. Last year was a decent cat year, but still decent earnings. Investment income still solid. So the capital positions of these companies are quite strong. They are also not the biggest insurers in the state. So mutual companies like State Farm, Liberty Mutual, they're kind of the biggest ones. And a lot of the high-risk homes are in the state, well, not the state, but the private fair plan. So this looks like it'll be an earnings event in the first quarter. Should you see multiple events, it could be higher.
So hang on just one second. When you say fair plan, and I've seen that a couple of times, what exactly are you referring to?
The fair plan is what's called a residual market, meaning if you can't get insurance anywhere else, you can get it through this private entity that was set up by the government.
Sorry, I just...
No, fair enough. I mean, we should clarify what that is. But one interesting thing for me about the insurance industry is when you see earnings events like this, as you say, often pricing hardens after. And you have a lot of Americans already suffering with higher insurance costs elsewhere. What is that expected to look like coming out of this?
So I would expect California home prices to continue to go up. They're already high, but the insurers in the state will say, we're already not making money aside from these large events. So pricing inadequate now, and we'd probably need more. The governor there is that it is regulated by the state. So I think you're going to see a lot of interchange with companies coming in and out, but I think the net cost to consumers goes up.
All right, Matt, thanks so much for joining us. We'll continue to follow your analysis on Bloomberg Intelligence. You type BIGO on your terminal to see Matthew Palazzola's analysis on the damage being done here and what's insurable there. Coming up, bonuses are set to grow on Wall Street. It's a sign of optimism for the year to come, and we're going to go through all of the details for you next in our Wall Street Beat. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
And it's time now for the Wall Street Beat. Today, Wall Street bonuses. We are going to talk about how they're jumping by double digits in many areas. We're going to get details from Bloomberg's Catherine Doherty, because the way bonuses work is they're never distributed equally. Of course, that is where the infighting starts to come into play at many of these different firms. One thing that interested me in your story today is that, okay, you have trading desks rising by 10% or more. Goldman is expected to rise even more than that. So what does this mean for the talent war on Wall Street?
So you always see all of these banks kind of positioning, they're asking, what are my competitors doing? How are they paying their talent? Because what they don't want to do is lose their best people, right? So even in down years, we have seen payouts, maybe not in these kinds of numbers. This is a very positive year. In down years, when you do see banks paying out their best people, it is to retain talent. So when you see a Goldman positioning and paying their traders more, it's both a reflection of their year, how they ended, and where they're at compared to a year prior. But it's also a signal to their people that they want to have them stay and continue on and build the momentum into next year.
So business was good in 2024. Business is expected to be good in 2025. But compare this to what we saw in 2020, for example, because we know that trading was really hot in, of course, the aftermath of the pandemic and during it. But that didn't necessarily translate into these big bonuses that maybe we're expecting to see now. What's different?
So we had 1 year around 2021 where the payouts were larger than what we're seeing now. And that was a reflection of both the volatility that then translated into actual revenue that these companies were generating so they could pay out their talent. And not just the best, it was across Wall Street. So this year, you're seeing the payouts that are up compared to a year prior. Last year was a tepid bonus season. You saw mostly flat across Wall Street with some getting paid in the single digits, but not the double digits that we're seeing this year.
Who's doing worst? Who's doing the worst here?
So I would say, honestly, that looking at these big banks that we reported on, it's a pretty level playing field with some, as you pointed out, Goldman, JP Morgan paying up their investment bankers higher. That is a reflection of where they're ending in the league tables. They continue to be number one in investment banking. So there's slight discrepancies, but I would say overall this average is not so different across the big banks.
You know, we're looking forward to your reporting next week. Of course, Katie, their bank earnings next week, and we're going to see just how good everyone did and their expectations for volatility in the Trump era.
Yeah, it should be fun to sort through all those. I'm sure we'll see you again very soon with that in mind. That, of course, is Bloomberg's Catherine Doherty. Meanwhile, let's get back to these markets right now. Volume 45%, the 20-day average when it comes to the S&P 500. And that's because we have a down day on Wall Street, of course, following that jobs report at 8:30 this morning. You can see the S&P 500 at session lows right now, down 1.2%. A lot of that pain being felt in big tech, and the NASDAQ 100, a lot of that pain being felt in the small caps. The Russell 2000 down about 1.7%. Of course, higher for longer is the conversation we're having right now, and higher for longer equals pain for those small caps, Matt.
That is exactly, well, I'm not sure about the small caps, but higher for longer is what we're going to talk about with Julia Coronado. She's coming up in the next hour. She used to contribute to the Fed's economic forecasts. She may in the future as well. Who knows? We're going to talk about the labor market with her, as well as inflation expectations heading into Trump 2.0. This is Bloomberg.
Offers before to take over Greyhound, but then in the middle of the pandemic 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years of Greyhound history.
My vision is to transform long-distance bus travel in the United States and make it one of the top considerations for anyone planning a long-haul journey.
CEO Kai Boyson imagines even more potential if state and local governments recognize the need to support long-distance bus travel with integrated infrastructure.
We need to think about the infrastructure in the United States holistically and think about the transportation system as one integrated system. And intercity bus needs to be an integral part of that system. One should be able to connect from one mode of transport to another seamlessly, easily. We have great success models in the United States. For example, Los Angeles Union Station, Boston South Station, or New York Port Authority Bus Terminal, or Washington, D.C. Union Stations.
Kai and the team, they are doing a fantastic job. They have really improved the product, they have improved technology, they have really made the production more efficient, that at the moment it's also a profitably growing business.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Breaking news from New York, where President-elect Trump is appearing virtually right now, receiving a sentence in his hush money case. Judge Juan Marchand had already signaled Mr. Trump would not receive prison time or probation for the 34 felony counts. Legal contributor Jessica Levinson.
These types of sentences are based on a judge's decision that really nothing other than the conviction itself would serve the interests of justice.
Mr. Trump, wearing a red tie with white and gold stripes in front of a black backdrop of American flags, said it's been a, quote, terrible experience. Last night, the Supreme Court denied his bid to block sentencing. The High Court is hearing arguments this hour on TikTok and whether it should be banned in the U.S. on January 19th if its Chinese parent company doesn't sell the platform. Legal analyst Thane Rosenbaum.
Free speech and freedom of the press issues usually get very broad First Amendment protection from the Supreme Court over the decades. That would be in TikTok's favor. But the Supreme Court is always very respectful to the executive branch when it comes to national security.
Scorched earth in Southern California.
Not just me, it's the whole neighborhood is gone. I don't know how we're going to come back from this. I don't even know where to start.
Juan Perez home in Altadena among the 10,000 structures that have burned to the ground in this week's raging wildfires. At least 10 people have been killed, and now there's insult to injury. CBS's Chris Van Cleve.
These looters are being arrested as they can be caught. But we're also hearing that some Altadena residents are choosing to stay in their homes if they're still standing, even without power, without water. Some, we hear, are arming themselves to try to protect their belongings and their neighbors' belongings.
Employers closed out the year with a burst of hiring. The Labor Department reports a better-than-expected 256,000 positions added. Business analyst Jill Schlesinger.
Leisure and hospitality added 43,000 jobs during the month. Healthcare added 46,000 jobs. Retail was up by 43,000 in December.
Markets down over worries the jobs picture may be too good and keep inflation and interest rates high. An unusual winter storms bringing snow and ice to the south. This woman waited overnight at Dallas-Fort Worth Airport.
We're just going to stay up here until they're ready to load us up.
Business has been brisk at a Piggly Wiggly in northern Mississippi.
Been rocking and rolling, that's all I can tell you. Milk, bread, and eggs has been our biggest seller.
Dow is down 388 points, S&P off 72. This is CBS News.
people love.
The Dow down 587 now. An embattled Hollywood star is taking new court action.
Alec Baldwin is suing prosecutors in New Mexico. Last year, a judge tossed out a charge of involuntary manslaughter against Baldwin for the fatal shooting on the set of the movie Rust in 2021. He alleges defamation in the suit and malicious prosecution with evidence intentionally mishandled, looking to scapegoat him. The special prosecutor who's named in the suit says she looks forward to a day in court. Steve Kathan, CBS News.
The hottest housing market in the U.S. for 2025 is pretty cold right now. New numbers from Zillow show high demand and limited supply have sent prices soaring in Buffalo. With 2 new jobs created for every home built, the economy in New York's second largest city is booming. By the way, it's 20 degrees in Buffalo right now. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so go to youtube.com, search Bloomberg Podcast, and that's where you will find us. Alex Steele's out today, not to worry. Bloomberg News, Norma Linda joins us. Nora, good morning.
Good morning. Happy Friday.
Happy Jobs Day. Jobs came in much stronger than expected. We're seeing some big movements in the stock and bond markets. John Tucker will give us that coming up in just a moment. Coming up, we're going to check in with Joni Biley. She's a division president at Employee Bridge. Get her thoughts on this labor market. Jeffrey Cleveland, chief economist at Payton & Regal, will get his thoughts on the labor market and what it means for the Federal Reserve. The bond market's telling us they're not going to be cutting rates until maybe October. Matthew Palazzola, Bloomberg Intelligence insurance analyst. He has doubled in the last day his insured losses from the LA fires from $10 billion to potentially $20 billion. So again, the numbers keep going up there, and we certainly keep our friends in L.A. in our thoughts and prayers. George Ferguson, Bloomberg Intelligence aerospace and airlines analyst. We're getting some good numbers out of Delta Airlines. People are back in the skies flying in a big way, including the business travelers. We'll break that down with George. So we got a lot coming up. Let's go to John Tucker and get a Bloomberg Business Flash.
All right, Paul and Nora, so you want more data. Just crossing a few minutes ago, the University of Michigan Sentiment Index, 73.2, so that's a little lighter than the prior reading and lighter than what economists surveyed by Bloomberg were expecting. I usually go right to the inflation expectations. The one-year inflation expectation higher than expected, 3.3%. The 5 to 10-year inflation expectation, 3.3%. Again, that is higher than the estimates. And of course, 8:30 this morning, Wall Street time, non-farm payrolls increasing 256,000. Good news is bad news. The bond yields surging, and as a result, stocks are sinking. The swaps traders reducing their bets on the number of Fed rate cuts this year. This does make the case for a Fed pause. The long bond initially breached 5%. The 30-year right now, 4.96. So that's up 3 basis points. Claudia Sahm of New Century Advisors, she reacted to the blowout jobs report.
You know, regardless of market reactions, good news is good news. These are jobs being created. The unemployment rate ticked down slightly, right? Like we need a resilient labor market. We need a labor market that's working for all workers if we're going to get through this year.
And let's go through the stock reaction. S&P 500, 100 points lower. That's down 1.7%. 58.18 on the index. So since the start of the year, we're now lower for the S&P 500 overall, erasing some of the gains. And the Trump sentencing going on in Lower Manhattan, and just getting some headlines crossing about that. Trump getting, of course, no jail time or probation. This is kind of expected in the hush money case that's taking place in Lower Manhattan. And we check the markets and other news all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Nora and Paul.
All right, John Tucker, thank you so much. We appreciate it. You know, that inflation data really got my attention. I mean, 3.3% for one-year inflation outlook. The consensus was 2.8%, and on the 5 to 10-year inflation, 3.3%.
And remind everybody what the Fed goal is, 2%.
2%, exactly right. So I wonder if this reflects maybe some tariffs coming into play, maybe, some of the immigration policy changes that might be inflationary. So we'll see that. Again, the news outside of the markets right here, just crossing the tape, as John Tucker was just reporting, Trump gets no jail time or probation in New York hush money case. That was essentially in line with expectations. Trump sentenced to unconditional discharge in hush money case. That's according to the judge. And that's kind of what we heard from the experts. We just spoke with June Grasso just moments ago, and that's kind of how she was teeing up for. So we'll see if we can get a few minutes of June's time going forward. June's time going forward. What are you looking at in this marketplace? I mean, we're seeing a sell-off in stocks and a big move up in yields.
Yeah, I mean, it's lots to keep an eye on, especially as we are really digesting this latest jobs report today. We're seeing energy as the best performing sector in the S&P 500, and then utilities is the second best performing right now. But we do have tech stocks as well as communication services as the two things weighing on the market today.
All right, very good. So we'll stay on top of that. Again, the short end of the curve here, the 2-year Treasury, which is kind of where I look at, up 8 basis points, 4.34%. Let's check on to Vince Signorella, Bloomberg macro strategist for Bloomberg News. Hey, Vince, we got that better than expected payroll number. The UMich a little bit weaker here. Some big movements in the stock and bond markets.
Yeah, lots. I mean, we're interesting when you're talking about, you guys talking about the Fed and what expectations are given what John was speaking about, the big jump in inflation. I think it's really rattled the markets a little bit when you put that together with the jobs data. You look at this practically, and the Fed funds target's at 4.5%, and the 2-year yield is at 4.35%. Riddle me this, Batman. How is the Fed ever going to cut in 2025? They're at where market expectations are. Are they going to say to the market with inflation basically sticky and potentially rising, and inflation expectations from consumers looking up, that they're going to cut rates through the 2-year? I find that really hard to believe.
Vince, you mentioned the idea of potentially the Fed actually not cutting at all in 2025. Do you think that the market and traders are ready for that? Do you think that they have actually anticipated and maybe thought about what the implications could look like in terms of market reaction?
I doubt it. They're looking now for the next rate cut to come in at around in September. Odds still at about 95% for July and nearly 85% for June. So I think they're sort of that monkey of the three of them with their hands over their eyes, if you will, not really listening to this, not seeing where the market's taking them. We're looking at lows in the stock market, S&P cash down over 100. The reality is you can listen to Fed people, as we heard yesterday from, I believe it wasn't Bowman, it was Harkin. Yeah, we're going to keep cutting. Where and why? The economy's resilient. I've never known a Fed that's cut interest rates while an economy was growing, with the exception of Volcker in the 80s when inflation was so high and it was coming down. So he was just marking to market where basically the traders were putting the 2-year and where inflation was going. This is a completely different story.
All right, Vince, thanks so much for joining us. Vince Signorella, Bloomberg macro strategist from Bloomberg News. The other major news story just crossing the tape and breaking this morning, Donald Trump, the first former U.S. president convicted of a felony, was sentenced by a New York judge Friday to no jail or probation for his hush money case. Joining us right now is June Grasso, Bloomberg's legal analyst here. June, no surprises here for you?
No, really no surprises at all. I thought it would take much longer if Trump decided to speak. So he did give a little rambling speech, echoing things that he said over and over again, how this is a witch hunt, how it's not fair, even talking, though, about the election. He got a few things in there. So, I mean, this is what the judge had said he was going to do. He was going to sentence him to an unconditional release. There was not going to be any kind of prison time, no penalties, no fines, nothing. It's just the stigma of now being a convicted felon and in 10 days being the first president to be sworn in as the president of the United States as a convicted felon. I think that's what he's been trying to avoid all along.
Well, June, it does say that Trump plans to appeal the verdict and seek to overturn his conviction through the appeals process. What would that look like? What is the likelihood of that outcome?
Well, so Trump has appealed just about every legal decision that has been handed down against him. So this is no surprise. He's already started to appeal some of the motions and some of the things the judge did. So what happens is once the sentence is handed down, they have about 30 days to say whether or not they're going to appeal. And then they do their arguments in an appellate brief to the appellate division in this case. And then he'll probably appeal whatever they say. If it's not good for him, to the highest court in New York, which is the New York Court of Appeals, and most likely to the Supreme Court, because he's going to be arguing about these presidential immunity decisions and whether they affected. In other words, what happened here is he said after that presidential immunity decision came out, he said that Judge Merchan shouldn't have allowed in some of the testimony, from example, for Hope Hicks, which had taken place in the White House, because that was done in the course of his presidential duties. Judge Merchan disagreed with that and also said that there was overwhelming evidence, so that wasn't even needed for the jury. So that's going to be definitely one of his points of appeal.
What else is out there for the president? Like most people, I can't keep track, and I think it feels like most of them are either resolved or dismissed or...
Well, when he takes office, nothing is going to happen to him at all for 4 years, because they won't go after. There's no prosecution of sitting presidents. The Georgia case is still sort of hanging around in appellate courts. The prosecutor there was thrown out because of a relationship with another prosecutor on the case. So that's left that very tenuous. That case is still there. But, I mean, really, he'll just have appeals of this, and the classified document case goes forward without him.
Something else in front of the Supreme Court, the TikTok case for... Hundreds of millions of people out there, I think, care about this. How do you expect this to play out?
You know, this is hard, and I'm about to try to listen to the oral arguments, so we'll try to see how the justices feel. It's very hard because in this case, the United States is claiming that this is a matter of national security. And with matters of national security, the justices usually leave it up to the executive branch. I mean, the executive branch has a lot of authority, and there's deference to the executive branch. But at the same time, you know, the First Amendment experts I've spoken to talk about this as a First Amendment violation, the violation of the First Amendment rights of the millions and millions of people who are on TikTok and who don't have any other way to express themselves exactly the way they do on TikTok. So we'll see what happens. One thing is for sure, it's going to be a very fast decision because they're going to come down with it before the ban goes into effect.
I know President-elect Donald Trump has also spoken out about his view on this whole idea of the TikTok ban. How much of a sway does it even seem that he would be able to make toward this decision?
Well, he has been... His views, as on many things, have been varying on TikTok. He was against it, then for it, against it. Now he is apparently for it. He submitted a brief to the Supreme Court as the upcoming president, the president-elect, saying that the court should delay the law going into effect so that he could come in and solve the problem. And it talked about him being a master deal maker and how he's the only one who can come in and solve this whole problem. I mean, how much weight that carries, we'll have to see.
All right, June, thank you so much. We appreciate it. June Grosso, legal analyst for Bloomberg, giving us the latest on the sentencing handing down from the New York court here on President-elect Trump, as well as the oral arguments being heard right now in the U.S. Supreme Court regarding TikTok and the ownership there. So we'll keep in touch with June. Markets are moving. S&P 500 off 1.6% today. The Dow's off about 580 points. The Nasdaq's off 2% here today. Stronger than expected. Jobs data suggesting that this Fed does not have to cut. They can sit on the sidelines. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, the data is just kind of piling it on. The University of Michigan survey sentiment showing a big jump in the median 5 to 10 year inflation expectation to 3.3%. Now, remember, the Fed's target is 2%. Combine that with a blowout jobs report that we got at 8:30 Wall Street time, and you get traders now guessing that, you know what, maybe the Fed is in no mood to cut rates. Treasuries, they are plunging. Now, the yield on the long bond, the 30-year, went above 5% for the first time in more than a year, since retreated somewhat right now at 4.93. Swaps traders are pricing at about 30 basis points of total Fed cuts this year, compared to about 38 basis points before the data release. A full quarter-point reduction is now not seen until at least September. And did get these headlines crossing the Bloomberg a little earlier. The U.S. imposing new sanctions on Russia's oil industry. They've actually targeted a couple of firms that handle over a quarter of Russia's seaborne oil exports. And let's do crude right now. This is Brent, the international benchmark. That's 72 a barrel, up about 3.5%. And U.S. crude, NYMEX, is up 3.9%. That's over $76 a barrel right now. The 2-year yield, that's up 7 basis points. That's at 4.33. Let's finish up with equities. S&P 500 down for the year. Down right now 85 points, down 1.5%, 58.32 on the index. Dow Jones Industrial Average down 543 points. That's a decline of 1.25%. The NASDAQ 100 down 367 points. That is down 1.75%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Nora and Paul.
All right, very good. John Tucker, we appreciate that. John Tucker with the Bloomberg Business Flash. It is Norma Linda sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. When we get to the economic data points we saw today, particularly the jobs numbers, we can do that with Jeffrey Cleveland, Chief Economist for Payden and Regal. Jeffrey, thank you so much for joining us. Jeffrey, I know you're based in Los Angeles. Terrible situation out there. I wonder if we could just get a couple minutes from you. You're right on the ground there in Los Angeles. What's the experience like?
Well, condolences to all the families who've lost property and loved ones. And, big shout out to all the first responders. I think it's just amazing working through the night here to try and keep things in check. This is an ongoing situation. We're still in the midst of it. Fortunately, in my personal situation, we've been very fortunate. And it's great to see the community in Los Angeles, a lot of neighbors coming together and helping each other. So I think that's been, one positive aspect of this whole affair.
All right, Jeffrey, our thoughts and prayers are obviously with our good friends out there in Los Angeles, so you guys stay safe. Jeffrey, we had a really, really strong non-farm payrolls number here today. What were your takeaways?
I think it's marvelous. All things considered, I'm usually very upbeat. It's kind of hard to be upbeat, here in LA on a day like this, but, the jobs data is excellent. I guess a few myths that have been debunked. One was that, Paul, high rates were going to derail the economy. It just really hasn't happened. Average payroll growth in 2024, I guess when all things are said and done, looks like it'll be around 186,000 monthly average pace, which is a little bit slower than 2023, but excellent job growth. It's keeping that unemployment rate just above 4% for the last 7 months, really, which is really remarkable, the stability we're seeing there. So I think this is a great jobs report, all things considered. If inflation continues to moderate, this is really the soft landing that we had been hoping for, and definitely the Fed has been hoping for. And so it's all around great news, actually, on all fronts for me.
So, Jeffrey, this was obviously good news, and when we think about the strength of the U.S. economy, but of course there are some speculations about how this could affect the Fed's rate cut trajectory. Of course, you mentioned that there is still scope for rate cuts in 2025, but when? What's the timeline for that, in your view?
I think the most important message for investors is that the Fed is not trying to slow the economy or soften the labor market. I think they're very content with where things are. As far as the labor market being a threat to the inflation outlook, I think those risks have diminished. So average hourly earnings back below 4%. So we're not in that situation where we were 2 years ago, where people were worried about a wage price sort of spiral. So I don't think the Fed needs to try to slow the labor market. They would like to stick the landing. They would like to get a soft landing. But I think they can be patient from here. I think for us that means waiting to see if inflation continues to moderate. We got a very favorable core PCE reading for November, just before the end of the year. So if we get more readings like that to start 2025, I think that could be very good news. So I think they can wait, be patient, no urgency to cut rates, but we do think they will cut rates over the course of the year. Right now, we're still penciled in at 1 cut per quarter, so about 100 basis points. But that's really driven by inflation getting back to 2% at some point.
Yeah, and it looks like, I'm just looking at the University of Michigan data, and they have obviously some one-year inflation outlook, 5 to 10-year inflation outlooks. Both of those ticked up to about 3.3%, much higher, well, I guess noticeably higher than where they were last month and higher than maybe the consensus forecast here. What do you think that data reflects?
I think that reflects sentiment, Paul. I mean, every client that I talk to, colleagues and friends and family members, they're definitely worried that inflation will pick back up. Whether that's something they're seeing in their day-to-day, or it's just the fear of maybe some economic policy shifts that are going to be enacted here that will push inflation back up. That's definitely palpable fear that you hear expressed. So maybe that's showing up in sentiment indicators. Looking at the actual data though for core PCE, we're pretty optimistic, Paul. We had that 0.1% month-to-month reading for November, and when we run the numbers, it's possible core PCE gets to 2% year on year by sometime in the third quarter of this year, of 2025, which will be fantastic news for everyone, for consumers especially. So I think that's maybe sentiment driving things more than actual inflation data that we're seeing.
Jeffrey, quickly, what was the driving force behind the pickup in the December payrolls numbers?
Well, I mean, I think, across the board, the surprise here is probably the government payrolls being in there, leisure and hospitality. I think overall, just everyone's expecting that the higher interest rates were going to lead to a cool down, a bit more notable slowdown. And we really haven't seen that. The 3-month moving average was 170K. So even if you exclude the December reading, you still see pretty solid 3-month average. So just a lot more resilience overall in the pace of payrolls the last few months than many people had expected.
All right, Jeffrey, thank you so much. We appreciate it. Jeffrey Cleveland, Chief Economist, Peyton Norigo. He is based in Los Angeles, so we wish him and all our good friends in Los Angeles Godspeed here as they deal with these fires here. Got an economic toll to the fires out in L.A. The numbers are just starting to kind of trickle in. Some Bloomberg reporting suggesting that the estimated total damage and economic losses from the fires in Los Angeles to be between 135 and 150 billion, a big jump from just a day or two ago. The question is, how much of that is going to be insured? Get an answer there. Matt Palazzola joins us, Bloomberg Intelligence. He covers all the property and casualty insurance companies. He joins us here in our Bloomberg Interactive Broker Studio. Matt, again, we're seeing some total economic losses north of $100 billion. How much of that is insured?
Yes, Paul. So those numbers typically include a lot more than what you're going to find in insurance. Include healthcare costs and lost wages, things like that. Yep. What we're looking at in our research is structures, homes, and businesses. So our scenario analysis coming out at around $10 to $20 billion. Usually you'll see those economic losses as many multiples of an insured loss. That seems like a high gap for this one, but I don't know everything that goes into those higher numbers.
When we think about insurance firms, how equipped are they to deal with this magnitude of devastation? What should we expect in terms of coverage there?
Yeah, I mean, this is their business, right? So we focus on the public large companies there. The leaders in market share in the state are mutual companies, which means they're not public. Regardless, this will be an earnings event, a manageable earnings event in the first quarter. What you get worried about is and this is obviously early in the year, so hurricane season comes along, you have several major events or an accumulation of smaller events that could start to put some capital concerns on. But for this event, large public insurance companies will be fine. So do we have any idea what percentage of homes and structures out there are even insured? Because I think I've been hearing stories that, more and more of these homes, even extraordinarily valuable homes and costly homes, either couldn't get insurance or maybe the cost was prohibitive. Is that a theme in your industry? Not exactly. Okay. I think anecdotally, I will say we've heard some things where on these super high-end homes, the insurance premiums could be so high that one might just risk it. But if you have a mortgage, then you need insurance. And even, some of these $3, $4, whatever, $1 million homes will have mortgages, so they'll need insurance.
When we're thinking about LA, what are some of the names that are associated? What insurance companies are most, suited to capitalize on this situation? So to capitalize is interesting. I mean, I think you're going to see a lot of disruption now. The California home insurance market has been in turmoil for a while already, and you're really seeing companies flee rather than be attracted to the market. I think in a kind of blue sky scenario, maybe this forces the regulators there to be a little more accommodating, and you might see the bigger names, State Farm, Allstate, maybe come back. I think that's probably optimistic. The opportunity I would see is there are some insurers who play in the kind of non-admitted market, which is less regulated, where they can kind of pick their forms and rates. Perhaps that would be an opportunity there, but there'd probably be smaller names. Interesting. So is there anything, does this impact any longer-term trends for your industry? Because it seems like Florida's a disaster from an insurance perspective because of their hurricane risk. I would think California has some dysfunction because of all the risk they have to deal with. So I'd say, Paul, it seems like the Florida market is improving. What these companies will say often is we can price for risk, we can't price for fraud, we can't price for regulatory issues. So Florida, the regulators have actually been working with the insurance companies. Has been a bit successful. California, not so much, and I don't see this helping. Right. All right. Matt, thanks so much for joining us. Matt Palazzola, he's a senior analyst. He covers the property and casualty companies. Seems like we only talk to him when there's disasters, but he's really a nice guy. Great guy.
Great guy. He does it all for Bloomberg Intelligence, joining us here. And again, I'm looking at some of the insurance companies, and I've seen a little bit of a sell-off here over the last several days, but nothing extraordinary. That would just be, really super get your attention here. But as Matt says, this is the life they've chosen. This is the business that they're in. But we're certainly seeing moves in the markets here today. The S&P 500 off 1.25%. The NASDAQ off 1.5%. The small cappers down about 1.8%. Big moves in the yield space as well. 2-year Treasury is up about 8 basis points here on the front end of the curve, 4.34%, and the 10-year Treasury up about 4 basis points, 4.73%. I'm calling out WTI crude oil up about 3.9%. Whole host of news out there that just makes it feel like there's going to be some issues there on the supply side of that equation. Bitcoin's up 1.4%, 93,300. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The economic data pushing Treasury yields higher. That is pushing stocks lower. The economy adding 256,000 jobs for the month of December. Way exceeding expectations. So what does today's blowout jobs report mean for Fed policy? Earlier, we put that question to Ellen Zentner of Morgan Stanley.
Yeah, things are pretty decent shape. I think that it means it's going to be higher for longer interest rates. It doesn't mean the Fed's not going to cut this year, and I certainly wouldn't put bets that they're going to hike based on this report.
Well, traders push back the expectations for the next rate cut to later this year and pile on. University of Michigan survey also showing a big jump in the median 5 to 10 year inflation expectation to 3.3% from the prior reading. Right now, the S&P 500 73 points lower. That is down 1.25% right now. The Dow Jones Industrial Average 556 points lower. The Nasdaq 100 is down 273 points. The 10-year did breach the 30-year, the bond, long bond, did breach 5%. That's come back down 493 right now. The 10-year, the benchmark, 473. That's up about 5 basis points. The 2-year is 9 basis points higher. That is at 435. Some of the stock stories include some real standouts, and they include Walgreens Boots Alliance reporting quarterly sales of $39 billion, and that is surpassing Wall Street expectations. As a result, Walgreens Boots Alliance stock up 26%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Nora and Paul.
All right, John Tucker, thank you so much. We appreciate that. Nora Melinda sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we're streaming live on YouTube. You should go to youtube.com, search Bloomberg Podcast, and that's where you'll find us. We have some earnings today. Delta Airlines, better than expected numbers. Stock's up 11% today. Not only is it a 52-week high, but I'm looking at my chart here. It is an all-time high for Delta. So let's get a breakdown of what's driving the good numbers out of Delta. George Ferguson joins us. He's a senior aerospace, defense, and airlines analyst for Bloomberg Intelligence. George, some good numbers out of Delta today. What's behind it?
Yes, so I thought they were some nice numbers. I think that Delta overperformed, I think, what the market thought and what we thought. And a bunch of that was on, this American Express remuneration, right? And so Delta's got a really good loyalty card program. And they saw a bunch more revenue flow through from that program. So I guess, when we look at it, I think it all speaks to the strength of Delta's franchise. I think the rest of the market won't see that same strength. One, I think, as you get into low-cost carriers, just the loyalty programs just aren't generating that kind of revenue. And I think as we peer a little bit deeper into the revenue story we saw from Delta, again, premium, which we've talked about previously, outperformed. It was 4 times the growth of basic, of the folks in the back of the airplane. And when we look at some of the key markets, like the domestic market, we saw yields, which we really think of as synonymous with fares, rising about 1%. So this is, not that exciting. We saw Latin America falling 1%. This is high season down there. That, a little bit concerning. Pacific was down significantly. And Atlantic was up 3%, was a nice story, I think, in a shoulder season when it's usually not that busy. But so some of the markets we're seeing, I think, maybe a topping out of fares, a little bit of softness. As I close, I'll just say, look, fuel gave Delta a really nice tailwind. It'll give all the airlines a really nice tailwind this quarter. And so that also helped.
George, we know holiday travel season is always very hectic. How was it when we think about the last quarter for Delta? Of course, you had like American Airlines where they were having their tech-related delays. How did Delta perform when we think about that season?
Yeah, so again, I'm going to go back to, the fact that their domestic business saw yields up 1% and tell you that tells me on average across the quarter, they're seeing maybe a little bit of improvement in fares, not a lot. there's still cost inflation inside this business. From pilots are getting annual increases that'll be sort of 5-ish%. And so does that 1% compensate for it? It comes close. So my guess is that the holiday season was good. Was it super outstanding? No. Again, I'm going to chalk a lot of this up to demand for premium, which I think people really go to Delta for, premium seating. And I'm going to chalk it up to that loyalty program.
What's business travel like, George? Where are we kind of relative to pre-pandemic, and are we at a new normal here?
So I think we're getting close to having recovered business travel, to pre-pandemic levels, which is not necessarily, it's good, but there should have been some level of growth since then, right? So leisure still really, looks like it's leading the recovery charge here. And, on the call, you still hear Ed Bastian talking a lot about his excitement over the Atlantic market. He's talking about how there was more demand there in the winter season. People see the streets are a little bit emptier. The weather isn't that cold in Southern Europe. When he's talking like that, that indicates to me he still doesn't have all the business travel back to where he'd like it to be. Again, there should have been some level of growth inside there. So it's really still, I think, a bit of a leisure story, and finding places that that he can sort of uncover leisure demand, and so he can source people flying the airline for some of those markets. I think it's still a bit of a leisure story. Business not fully as good as he'd probably like it. Probably not the same proportion of revenues that he saw pre-pandemic.
Well, yields rose 1% in domestic, which is Delta's largest market. They fell by 1% in Latin America. What was the story internationally as we think about it on a broader scale?
Yeah, so Pacific, Asia Pac was down, I'm forgetting, but I want to say mid-single digits roughly. It's a small market for Delta. It suffered from lack of capacity. Fares were quite high during the pandemic. So we see that one continue to descend to earth. Again, as I had left the call, I didn't hear him talking much about Asia Pac. It's not as important of a market. I think a big market on the international side, I know a big market is going to be Europe. And, Ed mentioned that bookings will start to flow through in the next couple months for Europe. He's excited about it. He should be, right? I think that the U.S. dollar has been very strong. The U.S. economy is hung in better than the European economies. He indicated, some of the information that we've heard from other sources, and that is that U.S. point of sale is particularly strong going to Europe. I guess one of the questions I'd ask if I was an investor in Delta is for, Atlantic, which is the big driver overseas, is this as good as it gets, right? Can the dollar get even stronger? Can the U.S. economy continue to outperform Europe as dramatically as it has? We saw good employment numbers today, so we seem to be a little bit exceptional. But I think, again, the international story is a lot of it is that transatlantic. It looks really good right now. The backdrop is nice. Could this be as good as it gets? Will this be the same way 12 months from now?
All right, George, I'm going to hop on a bird on myself Sunday for a little leisure travel. I will, of course, text you like I usually do. I usually text George like, what airline, what flight
Where are we
route?
going?
I'm going down to Aruba.
Wait a second.
I'm jealous, and he's leaving
Who's
us here.
filling in for this guy?
I could care
Because it's not
I think it's me.
Could be Nora. Exactly. So I was reporting to George. I say, plane is packed. Load
Give him the
factor.
play-by-play
Load
updates.
factor, 100%. All right, George Ferguson, thanks so much. Senior Aerospace, Defense, and Airlines Analyst, Bloomberg Intelligence. He could care less what I think, but I always kind of give him a little update on kind of how my flight is, a little anecdotal, so we'll see. But Delta Airlines, all-time high today. And the stock's up 60% over the trailing 12 months. United's up about 150% over the past 12 months. So the airline's doing well as people continue to travel. S&P 500 off 1.1%. The NASDAQ off about the same 1.1%. The VIX, 19 and change here. So we get up to that 20 level, which is a little bit of a worrisome level for some people. Yields higher. 10-year Treasury yield 0.5%. And we'll keep an eye on it. WTI crude oil up over 3% here today. That is on the move, and we'll stay on top of that. This is Bloomberg.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele is out today. Norma Linda sitting in for Alex. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We got big movements in the commodity space here today. And I want to really call out crude oil. WTI crude oil up 3% here, $76 a barrel. We were well below 70 for just a nanosecond ago. Let's check in with Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. He's lost somewhere down there in Miami. He doesn't know where he is. Mike, what's going on in the world of crude?
Hey, Paul, it's new positions. It's that time of year to put positions on, and they're getting long. A good way to indicate that is prices are up and open interest is up about the same amount on a percentage basis this year. Crude oil is up about 7%. Open interest is up. It's about 7%. That's a one-day lag. But I have to put my trader's hat on because this is the time of year you put on new positions, and we just bumped up against $80 a barrel in Brent. That's been my key resistance for a while, and I look at it as, okay, if you want the market to go higher from here, first of all, you're pushing against Mr. Trump, our new president. You're pushing against global trends, and you're pushing against Gina Martin Adams, who says the stock market is probably going to have some weakness for a while. So I'm viewing this level right now as pretty good resistance. And a good example of how we're just kind of in range bound is we're up 7% on a year in Brent, but on a one-year basis, Brent is up the same 7%. So it's all happening right now.
Mike, what do major commodities need to do to signal recovery from the post-2022 deflation trends?
Exactly. Good question, Nora. I'd say, first of all, Brent's got to stay above 80. Copper, I think, has to stay above $4.50. Natural gas has to stay above $4. Now, we pumped up to $4 at the end of last year. You have to stay above those levels to show recovery. Otherwise, I think it's just going to bring on what usually happens, bring on more supply and disincentivize consumption. And that, to me, is the bigger picture trend, particularly when we look what's happening globally. It's a bad environment for commodities, starting with China. Not only is China bond yields are falling, but we see declining demand for crude oil. We see declining demand for corn. A lot of that's just picking up in technology. So overall, and the bottom line is U.S. stock market has to go up. So to me, the tilt and the risk is towards deflation. And the key thing that's also happened today is that U.S. 30-year bumped up against 5% resistance. At the same time, Brent is bumping up against $80 a barrel. I think your prudent traders are looking at this and saying, hey, maybe I'll buy little bonds and sell a little crude and make it prove crude oil strength and prove more yield resistance above 5%.
2025, I know you guys put out your 2025 outlooks here. What's your call here on the greater commodity space, Mike, for commodities?
Down is the risk. Prices I think, are more likely to go down. The bottom line I think the measure is the market's the most trend ready it's been in about 30 years. If you look at exactly. If you look at the 100-week Bollinger Band, that's just a measure of the market trading for the last 100 weeks. It's the narrowest since 1997. So the market's ready to move. Trend ready is a term we use in commodities. It's just ripe to break out. It's just looking for a catalyst, and it needs something significant to make it go higher versus the normal trajectory, which is going downward. And I say that because we're still in the downward trajectory from that big spike in 2022. And what did that do? It pressured demand and increased supply almost all commodities. You can really see that in grains. We have a grain report coming out today, and we'll see if that can boost up prices a little bit.
Can Brent stay above $80? In your note, you mentioned that Bitcoin is a primary leading indicator. How so?
Well, when I was a trader, I would probably be shorting here. It'd probably stop me out, go higher, and then go down. And that's the thing that usually happens as an ex-trader. I can try to determine what's happening because I know what I would have been done. I think it's unlikely it stays above 80. I think it's more likely to go 60 and potentially a little bit low because the problem is we do have increasing demand. We have increasing global increasing supply and increasing global declining demand from China, and that's only usually requires a lower price to offset that. And the average cost of production in the world's largest producer and net exporter now for crude oil is $56 a barrel in the U.S. So I'm afraid it's going to take prices to get below that before it offsets. And the key bottom line is everything is the stock market has to go up for crude oils to stay resilient. Now, it's the beginning of the year. It's a little bit of a nuance. But in the bigger picture is the risks are stocks go down and everything heads lower.
A steak and eggs breakfast, that's getting really expensive. Cow prices going higher, egg prices. You can't even find
eggs in the supermarket.
You can't find eggs in the supermarket. What's going on there, Mike?
Yeah, well, the eggs are a bit off my radar. I used to have chickens. I don't want to do that anymore. It's kind of a pain. But I'll point out the key thing about meat. It's they're very well fed in this country. We have the major stocks to use, pretty high stocks to use of soybeans. We're worried about a big crop coming out of South America. Corn is still plenty amply supplied. Worried about big crops. Unless you get bad weather, those prices are going to go down. And the bottom line is, if you got time for a statistic, the total production of corn in China is about 70% less than the U.S. Yet they sow about the same amount of acres. They sow about the same amount of acres. What they're just starting to do is adopt genetically modified seeds, what they've been way overdue for, which means they're going to kick up their production. Their demand's declining. Their imports are declining, which means U.S. farmers have a problem. They have to find alternative sources of demand.
Interesting. Mike, always good. We'll get to pork bellies next time. Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence. You can go with Mike, cows, corn, grains to Bitcoin. All in a conversation. And oil. All in a conversation.
Wait, he used to raise chickens
Can you
in
get a better
Miami?
package?
No, he grew up on a farm out in Illinois.
Okay.
So, they actually did farming stuff. So he knows all. And then he went to the commodity trading pits in Chicago and did all that stuff. And then we got him to the East Coast, and then it's been all downhill. And, the first pandemic, he bailed. All right, folks, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121, presented by Oracle. Stay tuned for the latest news. Coming up, this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Norma Linda sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Coming up in this hour, a lot to go on. Rob Caroline, our Bloomberg meteorologist, can give us the latest on the LA fire situation. It's all about the winds over the next several days. Kate Duchesne, CEO of RGP, on the December jobs report. We'll get her thoughts there. Geetha Ranganathan, Bloomberg Intelligence media analyst. She's going to tell us what Disney's doing with ESPN. I don't know if they're teaming up with some of these other media companies. That seems to be on the kibosh, so maybe they're just going to go it alone. We'll see, figure out what's going on there. It's Friday. That means we talk municipal bonds. The favorite for Matt Miller and Alex Steele, neither of them are here, so we'll have to just muddle our way through. We'll do that with Eric Kozeski at Bloomberg Intelligence. So a lot coming up this hour. Let's kick it all off with Mr. John Tucker.
All right, guys, solid economic data adding up to solid losses for bonds and equities. The data showed job growth topping 250,000 last month. That propelled the yield on the benchmark 30-year bond to 5% for a time today. The robust jobs report implying that interest rates are going to stay higher for longer from the Federal Reserve. Mohamed El-Arian, the chief economic advisor at Allianz and Bloomberg columnist, says the jobs report today is more evidence of what he calls American exceptionalism.
Fundamentally, this is good for the economy. It confirms two things. One is the economy remains solid, and two is the U.S. continues to meaningfully outperform other advanced economies. And that theme of dispersion is going to become really important as we go forward.
Well, right now, the S&P 500 is 93 points lower, down 1.6%. It is lower for the year. Dow Jones Industrial Average down 641 points. The NASDAQ 100, 393 points. That is a decline of 1.8%. The 30-year bond right now, that is at 493. Two-year yield, 10 basis points higher, 436. The 10-year, that's 5 basis points higher. That is at $4.74 right now. And it's worth repeating crude oil. This is Brent, the international benchmark, $78.65 a barrel. That is up just about 2.2%. Real quick, some of the stock standouts. Delta, those shares jumping the most in more than 2 years. The profit beating Wall Street estimates. Those shares right now 9.5% higher. And crying in your beer, Constellation Brands cutting its growth outlook for the second time this fiscal year. Constellation Brands, those shares down over 13%. They make, anybody want to guess? Well, I know they make beer, but what brands? Modelo,
okay,
Corona, Corona Extra, and I've never heard of Pacifico.
Yeah.
Oh,
same thing as
good one.
Corona.
Okay.
Yeah, they're all kind of the same, going for that market.
All right.
Modelo, I see everywhere now, much more than I used to. It's just like they're all the same.
That's the one that everyone adds the lime, right?
Oh well, that's all right. That's your affliction.
No?
Red wine.
That's a Corona.
Corona's the lime? Okay.
Corona's the lime. All right, John Tucker, thank you so much. We appreciate that. Norma Linda sitting in for Alex Steele here today. I'm Paul Sweeney. We're live in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Of course, the big story this week has been the fires ravaging Los Angeles. The key issue there is the weather, and particularly the wind. So we've been trying to stay on top of that. Rob Caroline's been joining us and really helping us out here. He's a Bloomberg meteorologist. Rob, what can you tell us about the wind conditions out there in Los Angeles today and maybe over the next several days? That seems to be the real variable here.
Well, Paul, they're in the process of peaking or have peaked right now in the mountains around San Diego and also the Santa Monica Mountains. They'll start to come down in the next couple of hours. Certainly not as strong as what we saw earlier this week. Earlier in the week, they were gusting up over 80 miles an hour. We're mainly seeing gusts right now in the range of about 40, 45 miles an hour in a few spots, but most areas, the winds are about 20 to 30 miles an hour, so that's a bit more helpful. In regards to precipitation, unfortunately, nothing coming up for Southern California. They've had less than 0.2 of an inch of rain since October 1st in Southern California. They desperately need some, and it's just not in the cards. The reason for that is we're in a La Nina right now, so usually during La Ninas, the jet stream retreats up to the north, and they get plenty of precipitation in the Pacific Northwest and into Northern California, and that's what we've been seeing so far this year, but unfortunately, nothing making its way into Southern California.
Rob, what areas are you seeing the strongest magnitude of winds as of right now?
Right now, Nora, we're seeing them in the higher elevations. Some of the mountains to the east of San Diego right now are gusting to about 20, 25 miles an hour. Lower elevations, they're gusting between 15 and 20 miles an hour. Then as I go up the coast and I look at some of the locations that are located in the Santa Monica Mountains, I'm seeing some gusts right now to about 25 and 30 miles an hour. So it's down significantly from what we saw earlier this week, but any wind is problematic for them. So they'll have some more issues out there on the West Coast through mid-morning and then into the early afternoon. It gets much better there late this afternoon and tonight. The winds almost go calm, and they turn onshore. So that will bring a higher humidity in off the Pacific overnight, and that should help the firefighters during the day tomorrow. But then the winds start to come back up Sunday, and it looks like they may get particularly strong by Tuesday of next week.
All right, Rob, we'll stay on top of that. Thank you very much for all your reporting. Rob Caroline, he's Bloomberg meteorologist, joining us on the phone here. Big sell-off in the markets here today. The S&P off a little more than 1.5%. Emily Grafeo joins us. She's a cross-asset reporter for Bloomberg News to give us a sense of what's happening out there under the hood with these markets. Emily, what are you looking at?
Okay, so under the hood, there's actually some pretty positive gainers this morning. Walgreens Boots Alliance, they had a pretty big earnings beat. The sales beat up 7.5% year over year. Most of that was coming from the U.S. retail pharmacy sales. That was over $30 billion. The company said that this was really driven by higher prices for branded drugs and prescription volumes at their U.S. pharmacy divisions. And this is kind of easing pressure on the chain because it has been mulling strategic options, including a sale. There were some failed acquisitions or attempts at acquisitions for Walgreens over the last few years. But at least this morning, we're seeing the stock up right now, up about 25%, but it was up as much as 28%, biggest jump since December.
What else are you keeping an eye on?
So Delta Airlines, that is another positive earnings beat, biggest intraday jump since 2020, up 12%, all coming from fourth quarter revenue, profit, topping expectations this morning. And when you kind of dive into what their CEO had said of what was driving the earnings beat, the health of the demand environment, and the airline said that they saw a healthy bounce with corporate spending post the election. So once there was clarity with the outcome of the election, I didn't realize that that was like feeding into corporate travel plans, but apparently it was. And CEO Ed Bastian said that they saw a 10% jump in corporate travel sales led by technology and financial services companies.
All right. Yeah. Great stuff. Emily Raffeo, thank you so much. Cross-asset reporter for Bloomberg News, joining us here in our Bloomberg Interactive Broker Studio. The economic data point of the day, of course, was the labor data payroll number coming out, change in non-farm payroll, came out at 256,000, and the consensus was 165,000. So a big beat in terms of the labor market. We're seeing movement in the financial markets as a result of that. Let's break that number down a little bit. We can do that with Kate Duchesne, CEO of RGP. Kate, thanks so much for joining us here. Again, a big big beat on that headline print. What did you take away?
Well, I think that tells us that the labor market continues to be very strong. I think that's a good indication, although it will put a pause probably on interest rate cuts. But it does tell us that the market is stronger than we've all believed.
How are you thinking about it in the mix of the outlook for how the Fed could be viewing rate cuts in 2025?
Well, I think it probably portends a pause in January, and we'll see where we go. What we need to see is more movement in the labor market, not just new jobs, but movement. That really tells us that projects are starting to happen. So many companies are facing technological change and disruption. And we need to see more transactional work come back into the marketplace, and that then will signal that really post-election the economic market is improving.
Kate, how about on the wage front here? We had average hourly earnings on a year-over-year basis came in at positive 3.9%, just a smidge below the 4% consensus. What's the wage market look like?
Well, I think it's been strong, but it's, I'd say, cooling slightly. This is an interesting time of year because the quits rate is down, but that's to be expected given that so many companies are year-end and they are paying bonuses in the first quarter of the new calendar year. So people tend to stay put a little bit to get their bonuses and then start moving around. We are cautiously optimistic that we're going to start seeing more talent movement. It's been pretty stagnant the last 12 months as people have gotten more conservative in their thinking, both clients spending money and talent moving. But we're cautiously optimistic that that's opening up in the new calendar year post-election when economic activity may pick up with deregulation, tax cuts, et cetera.
What were the main drivers behind this big blowout report? We saw a big beat this morning. What was driving that?
Yeah, mostly it was in retail, hospitality, healthcare, and government. So, you have to look at where the activity is strongest, and it's not absolutely across the board. I think manufacturing was down, as a matter of fact. So, when you look at a report like this, you got to dig into the detail to say how does it impact particular segments of business.
We had news this week that's really important to global Wall Street. JP Morgan announced they want everybody back in the office 5 days a week, and that follows on some other big tech companies like Amazon making similar announcements. Are we going to see some change here? It kind of felt like the status quo was a hybrid thing, but it still seems like some big companies want to get their people back full time.
Right. So we work with some of the best brands in the world. We work with 88% of the Fortune 500. So we have a good pulse of what's happening in the workplace. And I would say absolutely the dominant trend is still a hybrid environment. So many highly skilled employees say they will not go back full time. So I think that while certain companies are laying down these mandates, very hard to enforce and very hard to keep high potentials who don't want to work that way anymore. So clearly what we see across the board in our client base is a hybrid approach. 2 to 3 days a week in the office for collaboration, learning together, and some flexibility, which is what high-performing talent wants.
All right. Kate, thank you so much. We appreciate that. Kate Duchesne, CEO of RGP. I don't know. I kind of feel like we're seeing a little bit of a move in that pendulum back to more in office versus less in office. I don't know, but I mean, Kate, again, she talks to all these Fortune 500 companies. I think a lot of people are going to still push back on that. We'll have to see how that plays out. All right, let's get to the media space. Interesting data point out here. Venue, which was going to be a sports streaming service with Disney and Warner Brothers Discovery and some others, and Fox, I think, they're not going to do it. I mean, they didn't even launch it, and they're already bailing out on that. So I don't know what's going on there, but I know who does. Geetha Ranganathan, she is the media analyst for Bloomberg Intelligence. Geetha, could you just tell us what is Venue, or what was Venue to be, and why did the parties decide not to go through with it?
Yeah, thank you so much, Paul. So Venue was really this skinny sports service that was having content from Disney, Fox, and Warner Brothers. It was supposed to launch last year, but Fubo, which is another player in the space, they're a digital pay TV service provider. They actually had filed a lawsuit against Venue saying that it kind of blocks competition. And so, because of that, there was an injunction which had blocked the launch of Venue. Now, earlier this week, in a somewhat of a surprising move, Disney actually merged Hulu Live TV, which is its own digital pay TV service, with Fubo. And as part of that deal, Fubo actually agreed to drop litigation, which potentially, I mean, theoretically on paper, it kind of cleared the way for the launch of Venue. So this move, or this announcement rather today, is somewhat of a head scratcher because we really thought that they had, kind of put everything in place to actually go ahead with the launch of Venue. But it looks like yesterday, late night, DirecTV and Dish had also come up with their own concerns, and they had said that, antitrust concerns regarding Venue were actually still very much in place, which kind of suggests to us that maybe Disney, Fox, and Warner Brothers said that, hey, it's really not worth all of this, legal and time resources being spent on Venue, so let's just scrap the whole thing.
Were in-house expecting this?
Nobody was really expecting this. I mean, first of all, nobody was really expecting that whole Fubo Disney move, which happened earlier this week. But really, that kind of seemed like this perfect setup for actually a go-ahead on Venue. So this, obviously, this is kind of our second big shock this week. But it really kind of goes to prove to us, despite everybody kind of wanting to make this transition into, streaming, Paul, as you very well know, there are so many legal and logistical complications associated with it. I mean, we've seen that time and time again. There was this short-form video service called Quibi, which basically was kind of dead on arrival. We had CNN Plus, again, never really took off the ground. So many of these services, yes, theoretically they're good, but practically it becomes almost impossible to implement.
Can you update us on what Disney's strategy is for ESPN in the streaming world?
Yeah, now I think all eyes, now that this whole Venue thing is off, I think all eyes are on ESPN. So the big move that happens this year, it happens in fall of 2025 when Disney is preparing to launch what they call the flagship ESPN product, which is all of the ESPN content, all of the marquee sports content actually going direct to consumer. Now, the big news that we're still kind of waiting for, Paul, is what the price point is going to be. So we knew that Venue Sports was priced at about $43 a month, but that included, obviously content from Fox, Warner Brothers, and Disney. Just kind of looking, crunching some numbers, we think that this new Disney ESPN service could be priced anywhere from about $22 to $25 a month. So then the question is, how many people are going to subscribe to the service, and will it potentially help Disney to offset all of the losses that they're seeing on the linear TV side? We think over time it will, but it's still a little bit of a wait and watch because we really need that price point.
So how big could this really be if they were to launch this ESPN product?
We think it can be really, really big. So remember, right now we have about 70 million pay TV households, but there are totally 130 million TV households. So that means 60 million households are actually not even subscribing to a pay TV service. So we think that, the ESPN product potentially can capture a lot of both the pay TV household audience, as well as the ones that we call cord nevers or, cord cutters who have just completely left the TV ecosystem. So the way that we're kind of modeling it out is we think that this service gets about, 10, 12 million subscribers by the end of next year, potentially reaches almost 30, 40 million subscribers over the next few years. years. But again, Nora, a lot of that is going to depend on exactly where they price the product and also what content do they offer. Do they go out and license more content from, let's say, some of their peers like, Fox or Warner Brothers?
Geetha, great stuff. I'm glad you're paying attention to it because it has passed me by, I'll tell you that. Geetha Ranganathan, U.S. media analyst at Bloomberg Intelligence. I mean, in my day, we were starting cable networks and financing
changed.
those things, doing IPOs for the TNN. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash. We are being brought to you by Oracle. Attention growing businesses, Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, this offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Well, today's good news in the job market may be too good and prove to be bad for Wall Street by keeping inflation and interest rates high. The stocks taking their cue from the bond market where the yields jumped. This all signals higher for longer from the Federal Reserve. The Fed has already indicated it's likely to ease rates fewer times this year than it early expected. This is because of worries about higher inflation. Also, you had data today from the University of Michigan that shows consumers expecting inflation in the year ahead to be 3.3%, up from an expectation of 2.8% last month. Right now, the S&P 500 92 points lower. That's down 1.5%. The Dow Jones Industrial Average 619 points lower. The NASDAQ 100 down 374 points. That's a decline of 1.8%. The long bond, the 30-year, it did breach 5%. It's back down to 4.95 right now. That's 2 basis points higher. The 10-year, 6 basis points higher, 4.74. The 2-year is up close to 10 basis points. That is at 4.36. And we look at some of the stocks on the move. NVIDIA slumping 3.2%. That is the lagger, the heaviest weight on the S&P 500. And after the announcement canning Venue, Warner Brothers Discovery stock, that is down right now over 5%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's focus on munis is brought to you by Build America Mutual. BAM Mutual insures municipal bonds that finance essential infrastructure and provide guaranteed income to improve any portfolio. Learn more about municipal bond credit quality. Visit bambonds.com. Eric Kozatsky joins us, Senior Municipal Strategist, Bloomberg Intelligence. He's down there on our Princeton, New Jersey campus. Recently renovated, great breakfast, great lunch. I know why people like to work there.
I need to get over there.
Yeah, it's awesome. And even years ago, I'm talking 5, 6, 7 years ago, EV charging stations there. I'm sure they got a lot more now. So the head of the game. And a major solar panel farm out there because they're in the middle of nowhere.
Of course.
So it's all good down there in Princeton. Eric, thanks for joining us here. Talk to us about the theme for your municipal bond market for 2025.
Yeah, I mean, so far, the theme has been outperformance, right? Look, the big story today has obviously been the move in rates coming off that hot jobs report. And if we look at sort of the moves today, right, Treasury's up about 6 to 10 basis points, and munis are up by a whole heck of a lot less just because it's such a good buying opportunity, right? Buyers are very keen to sort of hop on these tax equivalent yield advantageous levels, and they're sort of keeping things in check. And we think that's going to really be a continuing story this year.
So say the Fed doesn't actually issue another rate cut until October, like much of the bond market is pricing in. How would that affect the muni market?
I mean, I think that would be a good thing if we sort of hang in this channel right here, right? Because as long as people have the perception that inflation is still running a little bit hot and these economic numbers are still supportive of that, rates are going to sort of stay in this range. And like I said, on a tax equivalent yield basis, you know, for some of these high tax enclaves like New Jersey, New York, California, you're getting upwards of 8.5% on a tax equivalent yield basis, which is really, really attractive on a historical look back level. So, you know, definitely an opportunity here.
Any municipal bond market angle to what's happening in Southern California?
You know what? We're seeing a lot of bonds sort of come out for the bid, especially like LA Department of Water and Power, sort of like a knee-jerk reaction. It's hard to say right now how much of that is client-driven. You know, people calling their SMA provider or broker saying like, hey, we just don't want any sort of headline risk here. You know, if you're sort of like asking us what our take is, there's probably about like $50 to $70 billion of notional amount that's sort of in those fire rings, but a lot of it is tax-backed debt, right? A lot of things would have to go wrong all at the same time for there really to be a credit hiccup here. So we're sort of staying with what we said before, that in the history of municipal bonds really hasn't been an instance of a notable credit default related to a natural disaster.
So you mentioned that when looking across the spectrum at high tax states like California, Jersey, and New York, it appears that Jersey buyers have the largest advantage of buying in-state munis over treasuries. Talk to me about that.
Yeah. So, you know, once a quarter, we sort of take a look at what the advantage is or disadvantage of these high tax enclaves like California, New York, New Jersey, of buying their actual bonds for their in-state tax holders versus buying like a national name. Like if I'm a California buyer, am I better off buying a Michigan state GO? Because obviously I'd have to pay taxes on that, but sometimes because how tight spreads are in these high tax states, it is actually a better opportunity. And what we're seeing in New Jersey is that you actually have an advantage for buying out-of-state bonds upwards of 100 basis points, just because how compressed spreads are in the state.
See, John Tucker knows this, but I own so much New Jersey municipal bonds that when I call Governor Murphy, the dude picks up the phone on the first ring. I mean, let's be honest.
That's power right there.
Yeah, exactly.
That is power.
Hey, Eric, what's the new issue market look like in 2025?
You know, pretty robust. You know, estimates from a lot of people across the street were all over the place. I'm sure your banker friends will be very happy. We've seen upwards of 700 billion to 500 billion. We think overall it's going to be a pretty strong year because things just still have to get financed regardless of where rates are. 30-day calendar, we're looking at about 10 to 11 billion dollars coming to market. Obviously, the move in rates, you know, might throw a little bit of volatility and scare a little some of those issuers off to wait till things calm down a little bit. But we still think the majority that's going to make its way to market.
If you were to anticipate what some potential headwinds could be in 2025, what comes to mind?
I mean, taxes, right? That's really the biggest thing that is the biggest unknown for our market. What's going to happen to the exemption? Is it going to exist in its current form, you know, after they extend some of these TCJA provisions, after they find ways to sort of pay for them? That's really the biggest unknown. You know, we sort of bandy about and sort of think about this a lot because we're getting a lot of client questions. And again, we go back to, you know, the only areas of the market we could see, you know, realistically having some pressure applied to them might be the higher ed and sort of 501c3 space, just because of how much bad headlines they had in the last several years.
What's the taxable municipal bond market look like today vis-a-vis the tax exempt?
Not very great if you're looking at how rates are doing in the Treasury market. You know, look, our hope going into this year was that a lot of those cuts that were priced in were actually going to happen, and it was going to bring some life back to the taxable muni space. Obviously, with rates up here, that's really not going to happen. But look, the minute rates do go down, there are a lot of buyers who are interested in issuing in this space, number one, and there are a lot of clients who are interested in putting money to work in this space. So really, it's a matter of rates easing and matching those two up.
All right, Eric, thanks so much for joining us. Eric Kazatsky does all the municipal bond strategy stuff for Bloomberg Intelligence, located down in our Princeton office. Again, a big eco day. It's a big eco week. You know, we didn't have any real economic data on yesterday because of President Carter's funeral. So a lot today, a lot on Wednesday. But today, the highlight, I think, is that change in non-farm payrolls. Again, better than expected. 256,000 was the actual number. Consensus was 165, so a big beat there. Let's bring in Michael McKee. He's international economics correspondent for Bloomberg here. He joins us here in our Bloomberg Interactive Broker studio. So, Mike, again, the market, I mean, they're definitely reacting here. What was your take of that print?
A certain amount of it is probably payback from October, November, the hurricanes and strikes and things like that. And a certain amount of it is the seasonality, because we had a very late Black Friday and Thanksgiving this year. And so a lot of workers hired for retail jobs probably came on the payrolls later, and that shows up in December. That said, it's still a very good number that tells you that the labor market is not on the brink of collapse, which takes away any case for the Fed to continue cutting rates at the pace it was, especially since the unemployment rate went down, which is what they are really following. They're also looking at, on the other side, are they tight enough? And we saw wage pressures go down a little bit, but wages still running ahead of inflation. So it basically leaves you with the idea that they're not going to do anything in January, and the markets have priced out anything till like October, but we have a couple of big things coming up next week in terms of prices, and then after that, the big one. The inauguration, the 100 executive orders, et cetera, et cetera. And we did see in the University of Michigan today, inflation expectations went up a lot.
So I wanted to go there. I was wondering if that, again, just Mike was referencing the University of Michigan one-year inflation expectation. The consensus was for a 2.8% increase. It came in at 3.3%. So that's notable. 5 to 10 year expectation came in at 3.3. Again, expectation was 3. I'm wondering, is that maybe some of the respondents saying, all right, we've got this new president, he's talking tariffs, he's talking immigration policy changes. I think that might be inflationary.
Yeah.
Do you think that was some of it?
I think that was a lot of it.
Okay.
I said earlier on Bloomberg Television, do you remember the movie Broadcast News?
Sure.
Where Albert Brooks, the producer, is talking into the phone, and they tell the anchor what he's saying, and the anchor repeats it, and Albert Brooks says, I say it here, it comes out there. Right. And that's kind of what I think has been happening news people, social media, all kinds of folks talking about, well, Trump's going to do these policies and they could be inflationary. And I think that starts to sink into people's minds. And so they're talking about it. Now, if you break down the party affiliation for those inflation expectations, Republicans think that their inflation next year will be 0.1%.
Really?
While Democrats think it will be 4.2%.
Okay.
Independents think it'll be about 3.2%. So you average the Democrats and the independents, and you get the 3.3. So it's obviously
That's even
very
party
politically
politics
driven.
and statistics.
Party politics. So I think the Fed, bottom line, Fed probably looks through that this month.
Right. And speaking of inflationary, you talked about that payrolls report, wages running ahead of inflation. By how much? What is it looking like in the wage space?
Well, you can always choose your own inflation number. The Fed likes to look at the PCE numbers. But if you look at the way consumers look at it, they follow the CPI. So headline CPI is running at 2.7%, and year over year, average hourly earnings are running at 3.9%. Now, average hourly earnings are for basically hourly workers, non-supervisory. So that doesn't include any, the folks on Wall Street who get bonuses and managers and people like that who are on salaries. But it does show you that we're still seeing companies having to pay more to keep workers. And workers are still doing better than inflation. For a long time, they were not. And I'm not sure if it's sunk into them that they're doing better, but
it may not feel that way.
They may not feel that way. And that certainly came up as a topic for what happened in the election.
Sure, absolutely.
For sure.
All right, Michael McKee, thank you so much for joining us. Michael McKee, international economics correspondent, joining us here in our studio as we digest a lot of economic data here today, led by the change in non-farm payrolls, better than expected. Wages still going higher, again, 3.9%. The unemployment rate actually ticked down from 4.2% to 4.1%. So all in all, the markets, if you look at the stock market, the bond market, the currency market, they view that as a pretty solid economic number, suggesting that this Federal Reserve does not need to be in any hurry to cut rates. And now the market is pricing out a rate cut well out